34, we'll convene the board. And Jerry, could you lead the pledge?
I've been waiting for 2 years for this. Ready? Begin. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Mr. Chair, I'd like to comment that you know Jerry's a retired teacher, so you starts that. Ready? Begin.
She gets to hold the flag.
My honor to do that. That's true.
The first thing on our agenda is public comment. Members of the public are welcome to address the board on subjects both on and off the agenda. The board is prohibited from taking action on matters that are not on the agenda. Do we have any public comments at this time? Okay. We'll go to the consent calendar. Matters in the consent calendar are be approved without action based on consent. If we have the minutes of October 17th, the October 2018 retirement report, and the preliminary monthly financial report. Are there any items on the consent calendar that you would like to discuss? Seeing any public comment on the consent calendar? Seeing none, they'll be approved by acclamation. Number 3 is the administrative hearing. We have an appeal of administrative decision to require submission of certified marriage certificate in order to initiate survivor benefits. Do you have a staff report on this?
We do. Thank you, Mr. Chairman. Trustees, this is the first administrative hearing to come before you under our new administrative hearings policy, adopted a few months back. Mr. Celentano is here, and by our policy, he has 10 minutes to address the board, and then staff or MCERA representatives have 10 minutes to also address the board. You have the materials in the packet that have been provided. With that, Mr. Chair, I will turn it back to you, and if you'd like to offer the floor to Mr. Celentano, I feel that'd be appropriate.
Go ahead.
I came in here and I got the application and filled it out and brought in the documents that I thought were required. I understand that the first document, that the death certificate, is really important. And I think that you asked for a certified birth certificate or a passport. And I had a passport, so I brought the passport in. I brought in a copy that didn't have the raised letters on the marriage license, and I was denied the benefits. Now, in my feelings, the marriage license has nothing to do with receiving the benefits. It has nothing to do with what my wife signed 20 years ago. If it was required, I feel it should have been asked for 20 years ago. Once you decided to accept her and us as being married, and then reduced our benefits for 20 years, that there should be no requirement for a marriage license at the end of the process. That's really what my argument is. I think that, I don't know, I'd like to know from the board, why are you requiring a marriage license to get survivor benefits? That's what I'd like to know. It has no bearing whatsoever on the contract that my wife signed 20 years ago. And if it was required, it should have been asked for 20 years ago. I think this might be a recent decision that happened after my wife retired. And I have no, I mean, I can go over to Ukiah. I got married here in Ukiah. I could go over to the broker's house and get a copy, but I don't see any reason for it to be required in order to receive my benefits. I'd like to know what why the requirements there.
Yeah. Okay.
I mean, I'd like to know why it's there. I think that it's an unnecessary document. You should review your policies and change them. I mean, I audit governmental units. That's what I do for a living. I really think that this had to do with you being audited sometime and some auditor coming in and saying, that your files don't have marriage licenses in them, and you should get them. Now, I think that you could request them, but I don't think you can deny benefits because I don't provide one. I provided a copy of the license. And so therefore, for the last 4 months, I haven't received any benefits from survivor benefits. And I don't really need the money immediately, but I certainly feel that it's entitled to me. That's really all I've got to say. I just think they have a poor policy.
Okay. You've only used up 3 of your 10 minutes. Do you, so it's your position that you could get the married license?
Oh, I certainly could, yeah. I mean, could spend the money and I could have it a useless document that would have no bearing to me whatsoever in the future. And, but I don't see how you legally can deny me my benefits based on the contract that my wife signed 20 years ago. I have no other arguments. I mean, you just have a bad policy. I went to Sonoma County, required a death certificate and a social security card, and I got her benefits there. So this is not a norm to have provide a marriage license at the end. It's just at the wrong time. That's really what I'm saying.
Thank you, Mr. Chairman. Trustees, I will,
Before we move on,
Yeah.
will we discuss this? Is this an appeal this gentleman is making that we will be discussing? Or,
Yes, we will.
yes.
It was,
Is that what
we were off,
John
it was
said?
10 minutes for the appeal and then staff response.
you're not moving on to a separate
No, sir.
topic? I'm sorry.
Okay. Thank you, Mr. Chairman, members of the board. You have all of the materials before you. We do have a requirement that a certified marriage certificate is required on file for us to initiate a survivor benefit. That was not a requirement previously. It was put in place a number of years ago, I believe sometime around 2010. We instituted that practice. And it was put in place to help the staff and the board fulfill its fiduciary obligation to our members and ensure that we are paying benefits that are appropriate. We have these matters in place, these procedures to protect the fund. We recently reviewed our identification requirements as a point of reference for you, and changed what it is that we are willing to accept as verification of identity. We are now willing to accept a Real ID compliant government issued ID. So a Real ID state driver's license is new for us in what we will accept for proof of date of birth and who you are. So these processes, these requirements do change over time. We have made efforts to reach out to our membership through our newsletter. We put a notice out there about these requirements to initiate a survivor benefit. We have had some members come in and provide the documents. We do have a plan to do a major initiative at some point down the road to reach out and try to get our members to provide the documents before the death of a member. But this is the requirement as it stands now. We have it in place. We feel it's appropriate to ensure the system is fulfilling our fiduciary duty and paying the benefits that are owed rightly to our members. So with that, I'd be happy to answer questions.
Sonoma County doesn't require this. Are we the only county, the only 37 Act county that requires a marriage certificate?
I believe we are not. I cannot say for absolute certain which counties do and which counties do not, but very confident that we are not the only county that requires a certified marriage certificate.
Go ahead.
So how do we know at the time the person passes away that they didn't get divorced a year before? I mean, it's like, so you prove you got married, that doesn't mean you were married at the time of death.
That is correct. We do encourage our members, if they are experiencing a marriage dissolution, to get in contact with us, and we work with our members in terms of constructing their domestic relations order, which is the legal document on the dissolution of a marriage and how to separate assets. We never know for sure if there was a divorce. We don't do any kind of proactive search to ensure that there wasn't a divorce. It's on the members to advise us and reach out to us and make sure that we're aware and that they're constructing their domestic relations order.
Well, it seems like that's where the biggest potential for leakage would occur in terms of benefits going to people who aren't legally entitled to receive them. And I could see older couples divorcing for tax reasons and not being at odds with each other in any way. And it's, oh, well, we'll divorce this week, and when I die next, you'll get my benefits. So I mean, that's a whole kettle of soup that one could look at.
That I would agree. That's certainly a bigger issue, but it's not incident to this case. But it is something that we will think about in our processes. I hadn't even considered that as a potential there, but we'll put that into thinking.
That, and along with all those changes, which I'm not clear about at all, on domestic partners and the new definitions of marriage. What is marriage as far as we're concerned? So that's another issue, and it's transiency of marriage and or special relationships, whatever the term is this week. So those are other areas. It seems at the same time, I have a streak in me that if any of you have ever had a bank account escheat to the state, and you try and recover that money from the state of California, they want to stack this high of redundant verifications and fingerprints and passports and you name it. And it is really sickening how the state goes out of their way to make sure you don't get your money out of them. And that's put a bad taste in my mouth as far as making people jump through hoops that may or may not be unnecessary.
So I have a legal question. So in some cases, policies can be changed, but they're not effective retroactively. In other cases, you're allowed to proceed, going forward. So in this case, do you have just sort of a legal response to the issue of this policy was put in place after the employee retired, I believe, but prior to ceasing?
Yeah, I don't have any legal concerns. I think the question is, does the board believe it's a reasonable policy? I think that's the only legal issue, and I don't think a court would have trouble with the decision that the board makes in terms of whether it wants to require a certified marriage certificate.
And that's
even given the time.
And that's because it can be provided now as opposed to
Right.
in 2010.
Yes.
First, thank you, or sorry for your loss, and thank you for coming in and talking with us. But it almost feels like this is a bigger discussion, that we haven't discussed this since 2010, right? We haven't had this discussion as far as what we're requiring here. And it almost feels like this is not the time necessarily to do that for one individual. To me, it feels like, it sounds like the death certificate is available at the Mendocino County Recorder right now.
Probably,
Marriage.
I assume they have it, the marriage certificate.
Okay, marriage certificate.
Yeah, I assume it's there. I just don't have any reason to go buy one for something that I don't think is necessary.
Okay, and I,
That's,
right, and I do understand that, and I do, there's a lot of things that that you have to do that I don't feel are necessary.
and that's why I'm here, because I think that your policy is wrong and it should
Yeah.
be changed.
I just don't know if this is the place that we change the policy here. I mean, it feels like it's a deeper discussion than one case. Is there a way that we can obtain his or his marriage certificate?
No.
We can't obtain it
Well,
from the recorder's office? I mean, it sounds like he definitely has his reasons for not wanting to do this. And I think the goal is he wants us to look at this.
I want this policy changed.
Yeah.
That's what I'm here for.
Right, and I just don't know if one case right now is the time to do that, and if there's a way we can get around this, then bring it back and let the board discuss it at a later date.
I'm going through this now. After this came up, I had James check my file, and I don't have the required documents there, and I'm sending for them from Orange County, and one thing I learned is no one other than me can get them. They'll give you an informational thing with everything blacked out like it is here. So I don't think we can get it for him. But
Doesn't it seem reasonable that we have proof that somebody is actually married? Because
Well, I
we
think
have a
that when you sign
fiduciary
the
responsibility to
agreement, you
make
should-
sure that the check goes to persons who are entitled to it. And so we owe it to all of our other members that we're certain that that check is going to the right person.
Then why did you allow her to sign an agreement? You guys entered into an agreement with my wife, was to give her survivor benefits, and she took a reduced amount of pay for 20 years now, assuming that we had this right. And now you're coming along and saying, if I can't produce a piece of paper, I don't get the money. That's basically the way I look at it. Now, what happens if we got married in Zimbabwe or someplace like that, and I had to come up with a certified copy of a marriage license? It could take me years to get something like that document. Now, I understand that the document's an important document, and it should have been required when my wife retired. Because at that point in time, they must have assumed that she was married to me. And at that point in time, I think I had a legal right, once you signed your agreements with her. And I don't think that there is any other, I don't think this document is necessary at this point in time. I think it's just the wrong time. And that's why I'm here, because I think the policy is wrong. And I'm glad that I hear that you guys are going to discuss this in the future, because that's the reason I'm here. I mean, I drove 6 hours to be here. It's not like I just walked across the street to come here. This is very important to me to have policies that make sense to organizations. I audit governmental units. I see some policies that are terrible. This is what I consider a terrible policy, and I'm glad to hear you are now going to accept driver's license as identification, because a lot of people, if they didn't have a certified birth certificate, they probably don't have a passport, and they would have no way to prove that they were who they were without having a driver's license. So I commend you that you've made that change. That was one of the other things that I saw in the policy that really needed improvement.
Okay, thank you. James and then Patrick.
Thank you, Mr. Chairman. I'd like to correct a factual misstatement. There was no reduction in benefit for Mr. Salentino's wife. She had the unreduced benefit, and the continuance that he is eligible for is the 60% continuance. That does not reduce the member's benefit during their life. So there was no reduction in benefit that was paid there. We have these policies in place to protect the system and protect our members. I would strongly encourage you that we feel, the staff is very clear that we feel the policies are appropriate. We do look at these periodically at the staff level and do make changes when we feel it's appropriate. So with that, I would encourage the board to deny the appeal.
What Patrick has, yeah.
So I was going to raise a point just in relation to what Mr. Solentano said, because I've seen other programs where you have to provide certified copies, and usually there's a mechanism for people that aren't able to get it to show other documentation or proof from what I've seen. So I was surprised to hear that you were able to get one. So I think I was just gonna say, for the purpose of today, I would also feel that this isn't the right place to discuss the whole policy. If it's available to get, I think it should be obtained. But I'm also happy, I would be happy to review this in the future, now that it's come up, so.
Yeah. To me, I think none of the board members probably thought something like this would come back in 2010, when they agreed to vote for the policy that we put in place, had been in place for, did we just change it in July of this year, or was that the first time that it went?
The administrative hearings policy was newly adopted in July.
In July, okay.
Yes, so that, this framework is new that we created in July.
So I kind of think there's unintended consequences that, like he said, he didn't have to have this information when his wife retired however many years ago. And we have all these other documents, including the certificate of death that shows him as the husband of Sharon. And that's certified. I think in this case, we have other information that shows he was in fact married. And I think we might need to look at our policy and see if we can make it easier for the retirees when something like this happened, that if we have other documents that say, yeah, we had the document where she changed her beneficiary from someone else to him and named him as her husband. We have a lot of things here that indicate that he is in fact her husband. And I think we need to look at this again. I think I don't like the idea that we put into effect a policy that changes things that happened 20 years ago or 10 years ago, whatever it is. So I think we need to look at the policy again. I think, looking at the other things that we have from him, that I'll vote to agree with him.
Okay, James?
If I may, I understand that in this case, there appears to be ample evidence to support the existence of the marriage. I don't doubt that. At issue is the certified marriage certificate. And in this case, as a one-off, I might agree with you that there's ample evidence to support the existence of the marriage. But it's an incredibly slippery slope once you step off of the very bright line of a certified marriage certificate. What constitutes sufficient evidence? And I feel we are much safer and in a better position with having a very clear standard that is universal or nearly universal, and that we can apply in every case, and not have the judgment of staff involved in who's married and who's not.
One quick follow-up question for Jeff. Is common law marriages still recognized in the state of California?
I'm not sure, but I'm not sure what relevance that has to the issue.
Well, if somebody was common law married for 40 years and they didn't have a certificate, they can't get this benefit.
I haven't researched that issue. I think the question before the board is, do you think it's reasonable, given a fiduciary obligation, to require a certified marriage certificate? And I think that's the issue. I don't know the answer to that question.
Okay, Richard?
So Jeff, is this a quasi-judicial hearing?
It is.
So in that regard, if we're doing an interpretation, hearing evidence, making judgments, like Tim has talked about a preponderance of evidence to make a decision, is not necessarily going to change a policy at this hearing, nor particularly ignore it.
That's correct. You're making a final administrative determination, and if Mr. Solentano wanted to challenge it, he would go to Superior Court and try to overturn the board's decision today.
So it could be an interpretation of policy, or if at this point in time it's reasonable, and then then if it was determined that was the case, it's likely we would take it up as a policy discussion at another day. Is that
Yes.
all within the bounds of the administrative hearing?
So within the bounds of the administrative hearing is the decision about whether or not today to require a certified marriage certificate or not. That's the issue before the board today.
Or that we would make the finding that there is a preponderance of evidence that they're married and he should get his benefits.
You could,
If I may, so in the administrative hearings policy, there,
I gotta stop you. I'm asking this of our legal counsel.
okay,
Then you can tell us that, okay?
so what is your question?
That we could make a finding that he gets his benefit without this policy document because there's a preponderance of evidence stating that was married to Sharon.
I think the issue before the board today is to decide whether it's going to require a certified marriage certificate. How you want to rationalize that decision is up to the board. The question is, do you want to require that today, or do you not want to require it? And your rationale can be part of the decision, but it's ultimately the decision that this board wants to make in terms of simply whether it wants to require the certified marriage certificate in this case.
Thank you.
Catherine, then Jerry.
Yeah, I just need to go back because I'm not familiar with the retirement at the county. Do you have to be married to put somebody as your beneficiary? Because I didn't have to be. I mean, I could have given my son my retirement benefits or whatever.
if I may, Mr. Chairman, no, you do not have to be married to name someone as a continuant, which is different than a beneficiary.
Okay.
You have to be married to have a continuance, not a.
The other way
No.
around? Oh.
No, you do not. You have an option to name an individual with an insurable interest as a continuant, but not under the unmodified option. The unmodified option, it only can be a spouse or registered domestic partner.
Okay.
There is another retirement benefit payment plan option where you can name an individual with an insurable interest as a continuant. So,
Okay. And where is that information? Because I was trying to find it earlier when I was looking through this. Is that's in the county policies, not in the retirement policies?
that is in the 37 Act, and I'm not sure if those sections had to be adopted by the Board of Supervisors or if they're universally applicable. But it is in the 37 Act. And we
About
have
the
some,
unmodified and
yes,
modified.
and we have some documentation about that on our website.
Okay.
Jerry?
So my question is, if we were to grant Mr. Celentano the retirement without him having to have this certificate, what then would be, what would stop the next individual from coming in and saying, I'm not going to do it either? We have a policy in place. I'm very mindful of slippery slope. And I know it's a principle to you, Mr. Celentano, but if you went right over to the courthouse, I assume you could get this certificate and bring it back here. And
I'm
we would-
assuming they have it, but I'm looking at it for other people that might not be born, or not be married in a place where there is a easy availability for a marriage license or certified copy,
And
or
you,
even one that exists.
and you brought this up to us, and it's something that I believe this board will address when we talk about policies. I see a policy in place, and I, as a fiduciary, would find it very difficult to just ignore that policy.
You know, but I did bring in copies of marriage licenses. I brought copies in from the pastor in the church. I brought in all kinds of stuff. It's just, you know, and it's, I just get tired of jumping through hoops for no reason whatsoever.
Okay, Richard?
So parallel, a son or a daughter is in this position. Do we have to have a certified birth certificate for them to get the beneficiary?
I want to make sure I understand the question. If a son or a daughter is named as a continuant,
Let's start with, can a son or a daughter be in the same position that Mr. Celentano is in with Sharon, as far as a continuant or a beneficiary or whatever? Make it simple first.
if a child were named as a continuant, there would be no requirement for a certified marriage certificate. But there would be a requirement for a birth certificate, a certified birth certificate, or passport, or a real ID compliant state-issued ID.
Okay. So they'd have to come in with their embossed birth certificate and nothing else.
Okay, we've had more than 10 minutes of discussion. Does someone want to make a motion?
I move that we grant Mr. Celentano's appeal based upon the fact that he's provided us with a preponderance of evidence to satisfy us that he was indeed married to Mrs. Celentano, and in recognition that we're going to be reviewing these policies in the future, and I would not be at all surprised that the policy would be amended to say the certified certificate and/or other evidence of equal weight, something to that effect. So if we're going to review the policy in the future, I don't see any reason why we need to stick our plow in the mud right now. Mr. Celentano has a policy that he doesn't do things that he thinks is stupid, and neither do I. And I don't think that we should just stand on principle. He has his principles, we have ours. I'm willing to bend to his.
Second.
Any discussion on the motion?
The problem I have is you can get it. If you could not get it, I would absolutely support this, if there was no way for you to get it. But the fact that you can go to the admin center and get this, and probably it'll take you 5 or 10 minutes to get it, we definitely have taken your point into consideration that it's, maybe our policies go too far. We can look at that. I agree with what people are saying. It's a slippery slope if people come in here every time we have a policy. And I hate it that it's in this circumstance where you've lost your wife. But I just feel like because you can get it, my first take was you weren't going to be able to get it. That you couldn't get anything further. And if that were the case,
I don't know if I can get it, I don't even know.
were you married in this county?
Yeah, but that doesn't
Okay.
necessarily mean that the document's there either.
Yeah, but if you were married in this county, there should be a document.
It should be there.
Yeah. At the,
What
yeah.
happens if it's not? Then do I have?
Then I think you'd have
That's
total
fine.
support of this board to,
But,
yeah.
okay, it's whatever you decide. I just don't feel that the document's necessary for me to go buy a document to get something that I'm entitled to.
And it sounds like most of this board agrees with you
Okay,
on that, yes.
fine,
So-
and I'm ready for the vote.
Roll call?
Ms. Shatmeyer?
No.
Mr. Sullivan?
No.
Ms. Cavanis?
Yes.
Mr. Parker?
Yes?
Ms. Smith?
No.
Mr. Walker?
No.
Mr. Knudsen?
Yes.
Ms. Harris?
No.
And Chair Jordy?
No.
So 6-3, no.
I'm going to ask a question. Who seconded that motion? Okay.
Mr. Knudsen?
Okay, so it sounds like we will, at a future meeting, have the policy and maybe with some options on the board for the board to consider.
Yes, we will bring that back.
Now,
And-
can I ask a question? If you change your policy, can I come reapply?
I guess that's a question for legal counsel.
You can always reapply.
Okay.
I mean,
So can I be kept abreast of if you do make a policy change?
All of our information is public, our board agendas are.
Well, I'm just asking,
publicly
since
available.
it's kind of a specific thing to me, I'd like to know, I don't want to have to come to your website every month to see if you've discussed it or not. I thought that maybe I could be on a mailing list for this one issue.
Sir, think we've really given you a fair hearing on this, and, you know, we're gonna look at this.
Yeah,
Let's just go get the certificate, bring it in, let's move on. You know, we're gonna move forward on this. You've had a fair hearing, and we've really listened to what you have to say. And I don't know what more you really want from us. There's, you can push principle as far as you want, but just bring in a certificate. And
Well, I'd just like to know.
Let's just move on.
All I'd like to know is how the policy is gonna progress.
We'll see.
Okay, thank you.
Okay, next thing on our agenda is discussion possible action regarding investment matters, quarterly investment report.
You don't have to vote on that to reject it.
Yeah, that's what I.
Oh, well,
Well-
we've rejected the motion.
I thought about that, and I guess you need an affirmative action. Does somebody want to make a motion? I think you could do that. I thought about that, because the motion was in the opposite. Let's just do it. Does somebody want to make a motion to deny the appeal?
I'll move to deny the appeal.
I'll second it.
I think, Judy, you should do a roll call. I thought about that too.
Okay, sorry.
We get to the same place.
Discussion real quick. We should call him and tell him afterwards that we took this action. Thank you.
Ms. Shatner?
Yes.
Mr. Sullivan?
Yes.
Ms. Kavnis? Yes. Mr. Parker?
Yes.
Ms. Smith?
Yes.
Mr. Walker?
Yes.
Mr. Knudsen?
No,
Ms. Harris?
Yes.
And Chair Derby?
Yes.
Approved.
Okay, now we're on to quarterly investment
Okay.
report.
Okay, great. Thank you, it's good to see you. I have a new
Sidekick?
Wow, you got demoted, Claire.
Wait, you're the new sidekick.
I am Claire, I carry the bag for Claire. That's really what's going on. I'd like to introduce Claire Tallene. Claire has worked at Callan for about 10 years. In the last 7 years, she's been working in the San Francisco Consulting Group with me. And she's going to start accompanying me to these meetings and supporting you as one of our important clients. So Stan and James have met Claire in the past, and so Claire's coming up and is going to be meeting with you going forward, along with me as well. So here's Claire.
Hi, welcome.
Hi. Nice to meet all of you.
Nice to meet you. So our agenda item today is to go over third quarter performance. I'll give you a quick snapshot of what happened in October, because it wasn't pleasant. And we have a slightly different format today. Historically, we've walked through a report like this, a big report, and we thought we'd put together a summary presentation and just make it a little more easy for you to see the investment topics that we think are important for you to consider. I don't know the naming convention on the documents you have, but the document is landscape, and the front says Mendocino Performance Review.
Summary report.
Summary report, it says summary report?
Yeah.
Okay, that's for sure.
Well, there's two different ones.
Well, one's a summary, one's not. You look at,
Okay.
at least you look at their document labeling on the agenda.
My fingers don't always
I know.
get.
Tim knows how to make those really giant, so ask him how to fix it.
So nobody knows what's in there.
So I flipped ahead to page 2 here, and I'll provide a backdrop of what's been going on in the economy and the capital markets. I'll give you an overview of what happened with total fund performance. Claire's going to talk about the asset classes and the managers specifically. So on page 2 here, big takeaway here is that the economy has remained robust through the third quarter. Third quarter gross domestic product came in at about 3.5%. Pretty close to estimates, but that on top of the 4.2% increase in the second quarter made 2 very significant increases in GDP growth in consecutive quarters. So we're experiencing very strong growth. Some people think it's and somewhat transitory because of the tax bill that passed. Nevertheless, we're growing well above 3% over the last couple quarters. Inflation has picked up ever so modestly. We're sitting at about 2.3% inflation when you strip out food and energy. And unemployment remains low. So unemployment rate sits at 3.7%. We got a chart on that in a little bit. So very low unemployment rate. Wage growth is starting to pick up, and that's something that the Federal Reserve has been keeping a close eye on. And wage growth is really important because it means consumers have more money to spend, and consumers represent 7% of our economy. All of this means that the Federal Reserve has every green light it needs to increase interest rates going forward. During the quarter, interest rates, the federal funds rate increased to 2.25%, and that's full 2 percentage points higher than it used to be before. The Federal Reserve has indicated that it has every indication to increase interest rates another time this year and 3 more times next year. Now, the market doesn't think that it'll actually increase 3 more times next year. It thinks it'll be 2. But either way, we're looking at 0.75% to a full percentage point higher Fed funds rate over the next 12 months. The market is seeing that going on, so what's happened? Interest rates across the curve has increased, and that's what we're looking at on the bottom left-hand chart here. So the discount rate yields have gone up, and in October, this in part led to the equity market sell-off that we saw in October. So interest rates go up, it means that any future cash flow is worth less to you today than it did yesterday. So when the future dividends of the stock are worth less today when interest rates go up. The future rent from real estate is worth less. So across the globe, as interest rates go up, capital appreciation will be going down.
Just a question. So are the increase in the Treasury yields, are they reflecting the increase in the reserves, Federal Reserve's already put in place, or that they're anticipating that they'll be putting in place?
Yeah, so the 10-year Treasury today is about 3.1 or 3.2, I forget where it is. It's about there today. And the Fed funds rate is 2.25, but people think it's going to go to 3. So that 10-year Treasury rate, from an academic standpoint, is all of the future federal fund rates on average over time, plus some sort of risk premium that you take. Right? So if the market's efficient, then you should be indifferent in holding a Fed funds rate or a 10-year Treasury, less some sort of risk premium for assigning it. So it's baked into the numbers if you believe markets are efficient. Now, I could argue that this market might be inefficient because there are non-economic buyers out there. There are people who think differently from us, who are going to go out and they're going to buy a 10-year Treasury, whether or not they think it's a good investment vis-a-vis the Fed funds rate going forward. So who are those investors? Corporate pension funds have to buy bonds to defuse their liabilities. Insurance companies have to buy bonds. Foreign investors with a lot of money, central banks, have to buy U.S. securities to protect their currency. So those people, those investors might buy bonds when we don't think they're a good deal. And that might make the 10-year Treasury lower than it would otherwise be based on future paths of short-term interest rates. Across the globe, on the bottom right-hand chart here, you'll see that these are 10-year rates globally. You'll see that within the United States, interest rates are coming up, as is the case with the United Kingdom. The only place where it really hasn't happened yet is Japan. And that's the only central bank that is still aggressively following policies of quantitative easing. The United States is decreasing that, and it's decreasing in Europe as well. That means liquidity will be coming out of the market. Okay, so let's flip ahead to page 3 here. And I'll just ask you to focus on that first column where it shows the 1 quarter return. And just give you an idea about what happened in the 3rd quarter for performance-wise. US stocks had another strong quarter. Large cap up about 7%, smaller cap up about 4%. International stocks didn't do as well. And you'll see that they were up, if you look at developed markets and emerging, they were up, or developed markets, they were up about 1.5%, while emerging markets actually lost ground. And a lot of that had to do with currency, the US dollar strengthening relative to emerging currencies. So that had a headwind on returns. The bond market was essentially flat because interest rates came up. It eroded the income that you make off of bonds. What's notable to me, for the year ended in September, we actually have a negative return for fixed income. We haven't seen that for many years, where your bond portfolios lose money over a 12-month time period. And the way it's looking right now, we're going to have one of the worst bond market returns for a calendar year since 1994. Real estate continued to eke out gains, up about 1.8%, if you look at the average real estate investment. So in the quarter, stock investors actually did well. Large cap stocks up 7%. And when we get to your performance, you'll see that the fund actually had a pretty robust returns. But October happened, right? In October, there was a meaningful sell-off. And at one point, all of the gains for the year-to-date time period were erased. That's not where we stand today, because there's been a rebound in the stock market. But if you look at page 4, here's what the month of October is going to look like. US stocks down about 7%. International stocks down 8%. Bonds, that's the Barclays aggregate, down 80 basis points. High yield, so below investment grade bonds, down about 1.4%. There was no place to hide other than cash in the month of October. So this is one of the things that investors have been worried about for a long time. What happens when interest rates go up, bonds lose their value, the interest rates going up also affects the stock market, everything's negative. And that's what happened in October. So our estimate is that for the month of October, the plan was down about 5 to 5.5%. Okay, so pretty meaningful sell-off in the month of October. Not outside of expectations about what can happen in any one month, quarter, or year. This is not a bear market. This is correction territory. Double this to get to a bear market. Right? So, but it was a tough month of October. Your meeting's a little earlier than normal because of the SACRS conference. Most of the time we'd have the month of October flash report. We don't have that today because it's just earlier in the month. But our preliminary numbers are showing that the total fund's down about 5.25%. Okay, let's flip ahead to page 6 and then just show you a couple charts that I think are interesting talking about the economy. On the left-hand chart here, just look at the lines, and you don't need to worry about the numbers. What this is showing is discouraged workers, the amount of people who could be looking for work who aren't looking for work. And the big takeaway here is that this number is now down to where we were pre-global financial crisis. That means a lot of the slack in the labor market is going away. And in part, that's why we're starting to see wage inflation, which has been very hard for us to actually generate. On the right-hand side, this is looking at the overall unemployment rate. So the people looking for work, do you have work? And you'll see here that we're at lows that we haven't seen for many decades.
and is below this thing called, the red line here is the neutral rate, where economists come up and say, what should unemployment be on an academic standpoint? We're well below that. So that should be supportive of growth going forward and somewhat inflationary. If you look to page 7, you'll see that inflation really hasn't taken off that much yet, so because there are a lot of things that affect it. Break-even inflation rates on the left, this is what the 10-year TIPS is telling you inflation is going to be for the next 10 years. We're sitting still at a little under 2.2%. So the market doesn't seem to think that we're going to get runaway inflation, but it's certainly higher than what it was a couple years ago. Average hourly earnings has been picking up at about 2.7% though, and that's, as I mentioned earlier, that's great.
Great.
Yes?
I didn't mean to interrupt your train of thought there. The chart there on page 6, is that the labor participation rate? Is that what that measure is, the one on the left? Did
Not.
you hear that phrase?
It alludes to it.
Okay.
It's a component of it. It's not the, so sometimes that participation rate number, I've seen it expressed in a percentage, like 60%, or 55%, or something like this. But
Okay.
this is a component of it that says, okay, if you could be looking for work, are you looking for work?
Fair enough. Thank you.
Great. I want to, if I may, Mr. Chairman, on page 7, I want to tie that back to, we're starting to see some wage growth, but we're not really seeing inflation expectations pick up. Are the expectations just lagging, or are there other forces driving that, in your opinion? One of the ones that I'm particularly concerned about is debt levels. So what do you think is going on here? Is it just a lag, or is it other factors?
I think there are other factors. So wage inflation is a component of overall inflation.
Right.
And then there are other things in there. So this TIPS break-even inflation includes things like oil and energy because it's linked to CPIU. So that's in there too. But another thing is that technology is a deflationary factor in itself, right? You can do more with less work. And if, technology in the long run is deflationary. So I think that's also out there as well, component. If we're overly levered, that could be actually inflationary. If there's more money running around trying to buy a finite number of things, that can be inflationary. But there are a number of factors in here. It's not just wage inflation. Yeah. I'll flip ahead to page 10 here. And here the big takeaway I just want to share with you is that for a number of years, investors have done really well and savers haven't done as well. So if you save money and you just put it in bonds, you haven't done as well. If you had money and you put it in stocks, you've done really well, okay? But now, for the first time in a number of years, the 2-year Treasury and the 10-year Treasury are out-yielding stocks. So if I just bought a stock and bought a bond and said, I just want income, for a number of years, stocks did better than bonds. But now with the Fed funds rate going up, bonds are now out-yielding stocks. So that's going to affect the behavior of a lot of individuals out there. It's going to affect the behavior of insurance companies about their preference between stocks and bonds going forward. And so we could see a shift for the benefit of savers now as opposed to investors. When the global financial crisis occurred, policymakers overtly made the decision, I want to incentivize investment, not so much incentivize people keeping money and putting it, in a mattress, right? We're starting to see that shift a little bit. I'm going to flip ahead to page 13 and spend a quick minute on equity valuations. There are a number of ways you can look at equity valuations. One is by looking at how much do you pay for earnings in a stock. And sometimes you say, okay, earnings plus future growth, and sometimes you just say earnings. Earnings plus future growth gives you a different answer than this, and there's some charts in here that we could look at. But this is just looking at earnings for the price of stock. And one big takeaway here is that the United States, when you look at that, is looking as if it's valued well above the average that it's been historically. The United States, it's the S&P 500, it's the blue line. Where the green line and the yellow line are developed markets and emerging markets. And you see those valuations are less now. Perhaps there should be a premium for US because the US has been growing more. So, but they're clearly less than the blue line and they're closer to average. The best place to be for the last several years has been US stocks. We can't expect that to always happen, right? And if this is a very simplistic way to look at things, but this simplistic way is certainly saying that in the future, there might be more opportunities in international and emerging stocks than in the US right now. Okay. I'm going to flip ahead now to page 15 and talk quickly about performance in the US equity market. A couple big takeaways here is that for the quarter, growth stocks did meaningfully better than value-oriented stocks. And that's something you'll see come through when we look at the performance for your managers. And in fact, let's look at page 16 here. This has been a trend that's been going on for a little while. So let me explain this chart on page 16. The blue line here shows Russell 1000 growth stocks. So those are all the stocks in the Russell 1000 that are growth. And it shows their performance relative to the broad market. The green line are value stocks relative to the broad market. And they're mirrors of each other. You just take the index in half and you say, okay, if you're growth, you're value. And so they're always a mirror. But here are the big takeaways that for the last 10 years, these growth stocks have done better than these value stocks. What do I mean by growth stocks? They're technology stocks versus value stocks, which banks have been falling into that category for a while. And you'll see that over the last year and a half, the difference really accelerated. So when we look at your managers, you're going to look and see, oh my goodness, AllianceBernstein, they're geniuses. They made 31% in the last year. And then we look at your value managers and you think, oh, they're idiots. They're lagging by 20%. But a lot of the explanation about the deviation of their performance is, okay, what buckets do they fish in more than are they a good fisherman? Okay, so I just wanted to give you that context because there are a couple managers that don't look great right now, but it has a lot to do with the pond they're fishing in, not so much how well they're executed. Page 17, I'm going to digress here a little bit. One thing we're keeping an eye on is overall quality of the stock market. There's been a lot of people talking about and writing about the increased issuance of debt in the United States and corporations, the quality of debt being issued. There are more BBB issuers now than ever before. And then how about the amount of companies that actually have positive earnings in the Russell 2000? And you'll see that this bottom line here, the non-earners in the Russell 2000 has been creeping up. Those companies that, we own that company, but they don't make money. They're not earning money. So it's going to come in the long, well, Amazon for many years didn't make money, and it's certainly working out for them. The number of companies in the small cap area that have fit in that category has been increasing. Another thing that's been happening is there's been a lot of concentration within the US equity market. If you look at page 18 here, just look at 2018, the yellow bar and the blue bar. The yellow bar says how much of the return year to date has been from the 10 largest companies. And the blue bar says, how about all other 490? Mm-hmm. And you see the 10 largest companies have produced half of the return. That means the market's been extremely concentrated. And if you didn't hold Facebook, Apple, Netflix, Google, the FANGs, Microsoft, you could have lagged the market.
Is there a historical comparison to how the United States, how the stock market performed in the 50s, the 60s, the 70s, I mean, in terms of the profit coming from just the top 10?
There is, and we actually have a chart that shows that. I didn't include that one, but there used to be something called the Nifty 50 back in the day, and so back then the market was really driven by a small number of stocks as well. In the tech bubble, it was driven by technology and a few stocks as well. General Electric had a huge run, and boy, that's a sad story of where GE is at today. But if you go back when Jack Welch was the CEO, and Neutron Jack and all of that stuff, it was the largest company, and its growth could drive the stock market.
Sears
as
and
well.
Kodak, probably.
Sears and Kodak, absolutely. Sears and Kodak, I think they would have been part of that Nifty 50. Yeah. So it's happened before. And it's really interesting if you look at the size of sectors in the index over time as well. Before the financial crisis, financials became a huge part of the stock market. It's not as large anymore. And tech has gone up and down based on the valuations of that market as well. International stocks, big takeaway here on page 20 and 21 is that in the quarter, emerging markets had a tough run. And the only country that did particularly well was actually Japan, which ironically is the slower growth, more stable economy there. And then I quickly touched on the fixed income market earlier, where returns are flat for the quarter, but negative on a year-to-date basis. One thing that we're keeping an eye on is on page 25. James alluded to debt and the deficit. I was listening to an economist from Credit Suisse talking the other day. And someone asked him, what do you worry about? And he says, well, I don't worry about it today, but over 2 to 3 years, this is what I worry about, is the federal budget deficit. So if you look at the top of this chart here, we've had tax cuts and benefit cuts. And if you're running a deficit already, and you do that, the deficit's going to get bigger. And so this is the projection of the federal budget deficit. This is just the federal. Going forward, what does that mean? Is you have to issue more debt to pay for the things you do every day. And the servicing of the debt becomes a larger and larger and larger part of the economy, paying the interest on the debt. And that interest service cost, with interest rates going up, is the thing to worry about. More than the debt level itself, it's how much does it cost you to maintain that debt. And as interest rates go up, it's going to be a bigger problem. The more debt you issue, the higher interest rates go. So that's what we need to worry about over the next 3, 4, 5 years.
And Greg, I would tack onto that, the consumer debt levels are also extremely high. If you look across the spectrum, the mortgages, the auto loans, the credit cards, the student debt,
Debt.
everything, I think that compounds the point here and why I brought up the debt issue, so.
Yeah. Okay, so that was a lot about the economy and the markets. One takeaway for me is the economy and the markets aren't necessarily the same thing, but they certainly do look at each other. October's performance is a big example of that. Okay, so let's start looking at your plan. So at the end of the quarter, on page 29, we stood at $530 million. At the end of October, we're about $25 million less. That's a 5% decline. 25 million, $30 million, right? Those are the numbers we're talking about. And the target asset allocation on the right, actual asset allocation on the left, we were a little overweight domestic equity, In the quarter, we're probably closer to being on target today because of the drawback in the US equity market. On the bottom chart here, this shows the asset allocation on page 30. This is the asset allocation actual and target over time. Recall that a few years ago, we slightly changed the asset allocation target, increasing real estate and international equity and decreasing bonds. So we don't have a lot of bonds anymore. We're down to 22% bonds. And the bond portfolio, that's our flight to quality portfolio. That's the dollars that are supposed to do well in the down market. And so we don't have a lot of that in this portfolio. This is a portfolio that's designed to do well over 10, 20, 30 years and weather the storms over any 1, 2, 3 year time period. On page 31 here, we've talked about this in the past. This shows the green dot is the fund's current allocation. The triangles are the target. You want the dot to be close to the triangle. But then those floating bars are other public funds. This fund, for years and years, the policy has been to invest in predominantly public assets, a lot of US stocks, international stocks, and bonds. Other plans have invested in other alternative investments, private equity, infrastructure, and they've done so at a greater proportion. So this fund is heavily exposed to the changes in the public market and the stock market in particular. So as that stock market goes, our performance goes. Okay? And so let's talk about performance. And that's on page 33. So here we look at the performance of the plan. That, again, that's the green dot. And then the triangle, these are net fee, these are gross fee numbers because of the peer group. And then the triangle is the total fund benchmark. The big takeaway here is that over the long run, the strategy has worked out well. You're ranking well relative to peers and above that triangle over the long run. Okay? And if you look at the absolute returns, they look pretty good today, right? I mean, we've been through periods where you look at, the 10-year number, oh my gosh, this is, but right now the 10-year number is 8.3%, and 14 and a quarter number is 7.7%. So 10 years ago, if I told you we make 8.3 going forward in the heart of the global financial crisis, you say, I'd take that all day long, thank you. And frankly, that number's higher than what we predicted it would be by about 1% or so. So it's been a very good market for us for quite a while. We're showing 14 and a quarter years, not because it looks good, but that just happens to be the longest history we have on the performance of the plan. And over that time period, that you've outperformed your target by 58 basis points. Doesn't sound like a lot, but in a couple of charts I'll show you, that adds up. That means a lot over the long run. If you tack on another 0.5% for 14 years, your plan is 7 to 8% larger today than it would have been otherwise. That compounding really makes a huge difference. On page 34, we show your fiscal year returns. And over 2018 fiscal year, 2017 fiscal year, you rank very, very well. 2016, not so much. So one thing we've talked about here is that a lot of times we're in the top or the bottom, and it has to do with that reliance on the US and international stock markets, right? So our reliance on the equity market. And it's worked really well, but we can't expect it to always work well. Okay, so page 35 here, this is the chart that we put together just to show the importance of compounding. What this shows is over this 14 and a quarter year time period, what have the cumulative returns been? This isn't dollars, these are returns. of the plan over this time. So the green line is the plan and the red line is the target.
Should be one page ahead.
36.
36.
Oh, thank you.
2 pages of fiscal year return.
Oh, got it. Okay, thanks, Claire.
See, it's a good thing she's here.
Oh, yeah. Oh, yeah. There's a lot you don't see too. So on page 36 here, over 14 years, the returns are have produced 187% returns over that time period. So if you started with $1, you'd have $2.87 over 14 years. And if you had just the index funds, it was 1.6. So if you had $1, you'd have $2.66. So that makes a big difference. This compounding makes a huge difference over time. Another thing this chart illustrates is the up and down of the global financial crisis. You see that hump in 2008. And it's it took a while, but it's come back, and we should expect another hump like that, with the knowledge that over the long run, it works out, but you got to be able to stomach and survive the downturns. The next page, we look at the risk-return trade-off. And again, this is another way to illustrate the point. We've had a higher return. The ellipse are other plans. So we're over to the right, and we're up, which means we've had a higher return, but we've experienced more volatility to get there than other plans over time. Okay, does that make sense to everyone? Okay. All right. That's from the total plan level, how performance has been. It's been good, it's been a little volatile, and heavily reliant on public markets. So now I'm going to turn it over to the brains of the operation, Claire, and she's going to walk through the asset classes and then some individual managers we thought we should bring to your attention.
Sure. So Greg obviously covered the total fund performance, how it all rolls up, but when we look asset class by asset class, each of your individual asset class composites, domestic equity, international equity, fixed income, and real estate, it all works. What we look at is longer term performance, but also with an eye on the short term too. So your public equity implementation, your domestic equity managers in particular, have done really well over the long term. So if you look at page 40, we see the returns for the domestic equity composite, and anything 1 year or longer is double-digit returns on an annualized basis. So the total fund has certainly benefited, as Greg noted, from the run-up in the equity markets that we've seen over the last 10 years. And your implementation, when you look at returns of the composite versus that Russell 3000 benchmark, have been additive. Now the last quarter was a little bit more challenged versus the index, but again, we need to keep an eye on the longer term, and that's all worked very well. So as we look under the hood a little bit more, we've highlighted your two small cap managers. So Prudential is the small cap value manager on page 41. The following page looks at AB, the small cap growth manager. In the last year, Prudential has underperformed their Russell 2000 benchmark, but that's quite consistent with their style. So they're a true value, deep value manager. They've adhered to that style, and that's really just been out of favor. So they continue to look at that. Ultimately, this just hasn't been a favorable environment for their strategy. So more expensive stocks have continued to grow over less expensive or cheaper stocks, which is really what Prudential is looking for. However, if you look at the last 10 years, their style has worked relative to that benchmark. Now, Greg noted earlier, when you look at absolute returns for value in particular, they look just dwarfed compared to the growth manager. So that, as Greg noted, is really looking at an eye on the pond that they're fishing in, not necessarily their implementation. So page 42 looks at AB, the small cap growth manager, up almost 38% last year. So an incredible absolute return, and they've really outperformed their benchmark as well. Now, when you put those two together, Prudential and AB, that works exactly how you've implemented them to do that. So good complements to each other, certainly taking advantage of the longer term opportunities in each of their individual style buckets. International equity, covered on page 43. This has been the category that's been most challenging for this program. So we have the next few pages look at a deeper dive on a few of the individual managers, two in particular that have underperformed in the recent year time period. Again, if you look at the longer term time period, the last 10 years, one thing to keep in mind is that that does include Janus overseas. So that's going to continue to weigh on longer term composite performance. But as I noted, the last year has certainly been a challenge as well. So let's look at that a little bit deeper. Page 44 highlights Harbor International. This is an interesting one. At the last quarterly meeting, I believe, you talked about a change that was made to this fund. So Harbor is a fund that used to be sub-advised by Northern Cross. So Northern Cross is the asset manager that was implementing this strategy. And last quarter, Harbor announced that they were making a change to the sub-advisor. New sub-advisor is Marathon. Completely different manager that implements differently. The performance that you see here for the Harbor Fund is reflective of Northern. Northern had seen performance challenges for quite a while. They hadn't changed their knitting necessarily in terms of sticking to their strategy, but Harbor made a decision to change to Marathon. And we actually like Marathon. We know that manager well. Our conviction in them, in their ability to manage your money going forward is strong. But one thing we want to watch with Harbor, and this fund in particular, is flows going out. So because of this change, because it is a notable change, that's something we're certainly keeping an eye on. But we would expect performance to improve given that change to Marathon. The next manager we wanted to highlight is Oakmark. The underlying manager here is Harris. And Harris is interesting because they're either the first or the worst. They tend to be a very volatile manager. They require a lot of patience by investors. If you look over their longer term time history, anything 2 years and longer, they have excellent results. They've done very well for this program. They've implemented well. It has certainly benefited the results. But the last year has been a huge challenge, down over 6% versus a positive return for the benchmark, and they acknowledge that. When we talk to them, they know that performance has been really bad. But that being said, it's not out of line with our expectations for this strategy. So we still maintain conviction in this strategy, and we do think that if you continue to have patience with them, they should outperform. Now the last international manager we want to highlight is Mondrian. Mondrian has been a challenge in terms of performance, but when you look at the whole structure of your international equity implementation, they're a manager that's supposed to protect in down markets, and they've done that. So we highlight them here because they're intended to be in the structure to diversify the other managers. So we just talked about Harris. They're very, very volatile, a more aggressive manager in the structure. Mondrian helps diversify some of that risk. And if you look at the last quarter, they actually outperformed, which is just what we would have expected them to do. And we took a look at their October performance. They're also up about 1.5% in October. So that's why they're in the structure. We look to them to provide that protection, and so we're glad to see that they've done that. As a counterbalance to the international equity composite, the fixed income composite has certainly been a bright spot. So as Greg noted, that's about 22% of your overall portfolio, but it's done very well. Implemented with PIMCO and Dodge & Cox, two managers that we think are still very good complements to each other. PIMCO tends to take a top-down view of the market in their implementation. Dodge & Cox is very bottom-up. They're bond pickers. They're going fundamental bottom-up research. But when you look over the longer term, they've actually both turned in performance somewhat similar to each other, but just from very different approaches. And that's why we think they're still good complements. Over the last 10 years, the composite is up almost 5%, more than 1% ahead of the benchmark.
So when we look at the gross value of these bonds, is that the change in the market value of them plus the interest income that we receive during the given period?
Yes, it's total return. Yes, good question. In the last quarter in particular, both managers have outperformed.
So on the ratio, is that somehow broken down, what's sort of spendable and what's sort of bankable? In other words, appreciation I would consider sort of bankable, and the income that you receive would be spendable. And I think probably it's more germane to an endowment fund than it is to us.
So what this number is trying to say is if you sold everything you had and you wanted to spend every dollar, what would have the return been? So if you wanted to liquidate everything today, the return is, for the quarter, would be 36 basis points. When they get income, they reinvest it right away.
Oh, okay.
Some investors might take the income and pay out a dividend, and these mutual funds do pay dividends, but when they have a treasury mature, they'll take that maturing proceeds and they'll go out and buy another bond, as opposed to sequester income or maturities and sit in cash and then pay out for some sort of payout perspective. Yeah.
Last two managers highlighted here on pages 48 and 49. Ultimately, we just want to make sure that we're keeping an eye on the real estate composite in total. The two managers here, obviously Reef and Bearings. Reef has done better than Bearings of late. Bearings turned in another underwhelming quarter, but they certainly look different than Reef. So Reef tends to be, or has benefited from appreciation more than Bearings has. So Bearings' return is certainly driven a bit more by income than appreciation in the last 10 years when we've seen this run up in real estate market valuations, and Reef on the other side of that has benefited more from appreciation. So those levels are normaling out a bit. Both are coming back to closer to 50-50 income and appreciation, but Reef certainly has done a bit better of late and over the longer term as well. That being said, we still have confidence in both managers and continue to think that the real estate composite as a whole is an important component of your overall portfolio.
Where do we get to look at what their portfolio mix is? Whether it's international office or shopping centers, we need to be very concerned about the type of properties that we're investing in.
So we can get you that information. It's not shown here, but we do get reports from both of the managers that say, you know, we've got 22% in the west and 25% in the east, and we also have this much in office and this much in different categories. Both of these managers are very U.S. centric. They have very little exposure to anything outside of the United States. But we can, if you want that data,
I'd love to see that.
we can pull it together.
Yeah, if they print it up for it.
Yeah, they do. So that's the high level on kind of the managers that we pulled out to highlight this quarter. We don't have any recommended changes, but we certainly want to continue to look at both short-term and long-term performance, and again, keeping an eye on how it all fits together, so the role of each manager and asset class within the whole portfolio.
And the last time we met, it was with Jay Klepfer came up, and it's when we were in Fort Bragg. We spent a lot of time talking about infrastructure and other real assets. And one of our charges was to come back and do a deeper dive in infrastructure, because there was a question, okay, I kind of get the concept, but I need to understand this a little better. Like, what am I actually investing in? So we put together a presentation for that. Jane Mendy, our infrastructure expert, is prepared to come up here and walk that through you, walk that through with you.
Walk you through
Thank
it.
you. When there's a little more agenda time to do it. So we're ready to come up and take the next step, talking to you about infrastructure when time permits.
When are we going to see something on an impact of the trade war? The beginnings.
Well,
of the trade war.
in October, That was a bit of the response in October's sell-off as well. Some people attribute part of it to trade war. It's funny, and it's hard for the market to know what's a bluff and what's real on both sides. So I alluded to this economist I heard speaking the other day, and their theory was that it's just a way to set up for a positive surprise going forward. And so I think the market's really grappling with that. Okay, what's real policy and what's a bargaining chip? But trade war, it should be inflationary. The goods and services we import become more expensive. In the short run, inflationary. In the long run, if it depresses growth, that's deflationary. So it's very hard to figure out the direct impact on inflation. But in the long run, it shifts production to places that are less efficient, and that should be bad for growth. Right? If you start making something in a place where it's more expensive to make it, as opposed to a place where it's more efficient, that should lower growth across the globe. So we'll just see what happens going forward.
James?
Thank you.
Greg, I want to back up and, given the increase in volatility and everyone's expectation that markets are going to be down in the next year or two, should we be doing something different with our portfolio?
Not immediately. So this board has always been very good with policy, and we would never recommend you do something that is counter to policy, to set up policy and stick to it. And case in point, in a very difficult conversation. Right? We know in the next year you're going to be doing an asset liability study, and as a result of that study, you could take a look at how much money do we have allocated to stocks and bonds versus other diversifying assets. And I think that'll be the big conversation with that asset liability study. How do we keep our expected rate of return sufficiently high to meet your actuarial requirements, but also diversify the portfolio so that our downdrafts aren't too painful for us to experience. And that's going to be the challenge of the asset liability study you conduct next year. But I would not recommend you do something today to react to that, but without doing a study to come up with a long-term policy that works for the plan.
Thank you. I'm good, Mr. Chairman.
That's all we got for now. Okay. All right.
Very good.
Thank you.
Thank you. Great to see you all.
Thank you.
Thank you.
Okay, we'll take a 10-minute break.
Put my feet on the floor since they don't reach.
Okay, at 10:17, we're going to resume the board meeting. And the next thing on our agenda is the discussion of possible action regarding the June 30th, 2018 actuarial valuation study.
Very good.
Okay.
Hello.
Good morning, members of the board, Mr. Chairman. My name is Andy Young, joined by my partner, Doug Adamson, here from City Consulting, presenting to you the June 30, 2018 valuation. Agendized once the valuation is approved by the board, it would be used to formulate the contribution rate requirement, not just for the employee as well as for the members, for the upcoming 2019-2020 fiscal year. First off, I want to say that this is almost a non-eventful valuation, and the reason why I said that is in this valuation we have taken the same actuarial assumptions which were approved by your board in 2017 the board may remember you have a policy to look at, for example, the investment return assumption once every 3 years. So just counting 2017 was the first year, for example, we used a 7% interest rate assumption. So this would be the second year, the third year would be 2019, when all the assumptions will be looked at again, including, for example, when our members retire from the plan, how long our members live out of retirement, but that would be upcoming feature to, not until the 2019 valuation has been completed. So if I may ask you to flip over the report with you. By the way, I'm going to be doing my presentations primarily from section 1 of the report. I know that some of you are working on your iPad or your computer, so I'm going to limit the number of back and forth to jumping on the report pages. If I may ask you to take a look at section 1, looking at the page I, Roman numeral 1. As I've indicated early on, this valuation is done as of June 30, 2018. So for that reason, some of the comments that you have heard from the folks over at Callan Street do not apply when they provide to you the return for the first 3 months of the current fiscal year, as well as the return for October, only because none of that investment return performance have been factored or taken into account in this current valuation. So for the purpose of this valuation, we've only taken a look at the returns from the fund for 2017 and 18, and this is really a very good valuation rate of return, as you will see in the next several minutes, well in excess of 9% on a market value basis, and even after going asset smoothing method, we earn more than the assumed rate of 7%. So for that reason, I go back to my original statement, this is a rather uneventful valuation because contribution rates are going down, and we like that when it happens. And as a matter of fact, even though there's an increase in the unfunded liability, I will explain why, and it is because our members are, I would say, we're finally getting salary increases. There have been a run of almost 5 years where salary increases for active members are coming in lower than expected by the actuarial assumption. So for the first time, they're coming back up, and as a matter of fact, you can almost, and I don't have the number in front of in this report, but if you look at the investment or the salary losses or lack of salary increases for active members for the last 5 years, you kind of add them up from the last 5 reports, it will equal to the gain that we have from the loss that we have from this valuation. So that is now almost like normalizing to the long-term salary increase assumption. At the bottom of page I, this is where we repeat for the board the so-called actuarial funding policy. So when I'm looking at the very last paragraph on page I, namely that anytime we have any actuarial gains or actuarial losses, rather than to send a bill across to the county and ask the county to pay in 1 year those actuarial gains and losses, rather we smooth it out or we amortize that over a period of 18 years. With the end outcome that the contribution rate changes from 1 year to the next would be much smoother than it would have been, because any gains and losses would be paid off over a period of 18 years. So now turning over to page I, the next page. If we have to summarize what is in this valuation, the board may remember back a couple of months, I think it was in July, when you got a report from the actuarial auditor at Chiron. The good news is the folks at Chiron basically finds the assumptions that Segal has recommended in the 2017 valuation to be reasonable. The other good news is that Chiron has been able to replicate, basically calculate almost the same level of contribution rates that we have provided to the board and we have recommended to the board in the past for both the employer and the employees. However, when they took a deeper dive, they look into the level of plan of benefit. I think they were comparing membership handbook, that when they realized that there was a benefit, which is a $1,000 burial allowance, hopefully none of our members would call on that benefit anytime soon, but in any event, there was a benefit that was included in membership handbook that they did not find in our valuation report. So as a matter of fact, when we go back to our records, we did not find that in the valuation reports that were prepared by your prior actuary. Nonetheless, we think that this is really one of the reasons why you want to go out for an actuarial audit, is to have a fresh pair of eyes come in, make sure that all the benefits that have been approved by the Board of Supervisors are indeed pre-funded and are included in the valuation. So for that reason, for the first time in the history of the MSERA retirement valuations, we are now putting on for the first time a value of the benefit equal to a $1,000 burial allowance. So in this case, the benefit is not that big, but it nonetheless have an impact of about a $0.5 million increase in the unfunded liability for the plan. If we convert that into a contribution rate, it is about 0.06% of payroll, or about $41,000 per year. So again, you will see reference whenever we talk about the change in the unfunded liability, you will see the $0.5 million mentioned in that page. When you see the contribution rate reconciliation for the employer, you will also see reference to that as well. But you won't see that reference being made in the member rate, because this is really a benefit that is paid for exclusively by the employer. We also determine every year, compare how much assets we have in plan, compare that to the actuarial accrued liability, otherwise known as the funded ratio. So in the 2017 valuation, the funded ratio came in at 69.9, very close to 70%. In this year's valuation, we made a little bit of progress to 70.4%. Now, on a market value basis, so the first 70% ratio that I was talking about, use this so-called smooth actuarial value of assets. So remember I said when the fund earns, let's say in this year, substantially over the 7% assumption, we don't actually take all the market gains and use that to either reduce the employer's contribution or use that to calculate the funded ratio all in one year, but rather we smooth it out over 5 years. And the reason why we do that is we think that the market could misbehave, such as what we may have been doing already. So nonetheless, we call that the rainy day fund, where we take 1/5 of the gains that are in excess of the 7% assumption, spend that to reduce the employer's contribution rate in the current year, and save the remaining 80%, and have that be spent to hopefully stabilize and or reduce the employer's contribution rate for the next 4 years. So for that reason, if we were to use the market value of assets to compare that against liability, the funded ratio would be slightly better at 72.5%. So by the way, this is very loosely scripted presentation. If you have a question, please feel free to stop me, and I can try the best, and me and Dirk will try the best we can to answer those questions as they come up. And then in the next item, we talk about the comparison of the assets in the plan versus the actuarial accrued liability, otherwise known as the unfunded actuarial accrued liability. In this valuation, the amount of the unfunded actuarial accrued liability has gone up from $204 million to about $212 million. Now I'm going to actually ask you to flip a couple pages to the report for me. So if you would please turn to page 47. I know that some of you are looking at your iPads, so it may take a little bit of time, so I'm just going to do that. Give you a minute to turn to page 47. So if you're following on the hard copy, it's under section 3 on page 47, which is exhibit I. So on page 47 is where we actually reconcile how the unfunded actuarial accrued liability changes from last year's number of about $204 million to about $212 million this year. So starting from the very top, if all the actuarial assumptions of the plan were to come true, the unfunded liability would have gone from the $204 million in item 1 to the expected unfunded liability on item 5, which is about $203 million. So when we try to reconcile the change in the liability, we take a look at the so-called normal cost for the plan, which is the cost to provide for an additional years of service credit for active employees, offset by the employer and employee contribution, and then we adjust the whole thing with interest. So the unfunded liability would have gone down, in this case, very little, from about 204 to 203 million. Now, as we will get into on the next page, and the reason why there's just a very small reduction in the unfunded liability is the plan has gone through a resetting of the amortization period, so to speak, about 10 years ago. So with the end outcome that the bulk of the unfunded liability of the plan is still being amortized and still being paid off over a relatively long period of about 21 years. But in any event, there would be a small reduction in the unfunded liability if all the events, all the actuarial experience of the plan were to come true. So what really happened was that we do have some actuarial gains and losses. So for example, if we look at item 6 on page 47, in item 6A, we do have gains from higher than expected investment performance. So what we did was to take the over 9% return that we have recognized during 2017-18 only recognized 1/5 of that amount. Combine that with the deferred gains and losses from the last 4 years. On a net basis, there's still a reduction in the unfunded liability because the return on this move or average out value is over the 7% assumption. However, on the other hand, as I've indicated in my introductory remark, active employees are getting salary increases which are higher than what we have expected. That has an impact of increasing the unfunded liability by about $11.7 million. As I've indicated early on, even though it is not in our report, but if you are interested in looking back at the same line item, comparison of the salary increases either higher or lower than expected from the last 5 valuation report, coincidentally that number came up, the sum came up to be a salary gain of about 11 million. So I think in this case, it's really like, you can think of salary increases that could have been given in prior years, but we were not given. So now finally those salary increases are coming through.
So question, so outside of, this is a contract, and the other contracts for the other bargaining groups are pretty comparable. But this is the biggest bargaining group, and about 30% of the employees in this group had a 50% turnover in the last 2 years. And as a result, there was, outside of the bargaining process, supplemental adjustments upwards of those positions in pay, which kind of range from maybe, I mean, on average, maybe 10 to 20% bump in addition to this. So do you have that information? Because in other words, there's more than this for about 30% of the 700 employees in this group.
Yeah, now, I think in this case, Mr. Chairman, we have only used SEIU as an example. I think we were given salary increases for everybody. So to the extent that those salary increases have taken place already.
But they've taken place outside and after the bargaining process. So they've taken place really in the last 8 months.
Okay, so in that case, some of them may have been reflected. So all the increases that have already been granted through June 30, 2018 would have been reflected.
Okay.
Anything that is after June 30, 2018 would have yet to be reflected.
Regardless of whether it was part of a contract or outside of the contract process?
Yeah, as long as they are pensionable.
Yeah, definitely.
So that's the question, I guess, to you, Dan. So what you're saying is there was some percentage increase that was probably 2% or 3%. And I think that's what their actuarial number annual was. But you're saying people were upgraded in status 10 to 30%?
Maybe 22.
20% on the actual value of their position.
It's 30% of the general employees who had because their positions had a 50% turnover in the last 2 years. So that's why they were selected.
I see, so it was calculated, we'll keep losing these guys, we're gonna jack up their pay and maybe we won't lose them.
So they were brought closer to the market.
Okay. Well, okay.
Yeah, so I think to answer the question, so to the extent that those increases have already taken place as of June 30, 2018 will be reflected. Anything that happens after June 30, 2018 will be reflected in the next valuation. As a matter of fact, when I talk about the fact that the board has a policy to look at the actuarial assumptions every 3 years, so we call that the triennial experience study. And of course, one of the things that we look at as part of the triennial experience study is how rapidly our members go through the promotional process. So to the extent that these types of salary increases now it sounds like it's more permanent and the higher step rate may be in place on a permanent basis, they will be reflected not in the next valuation as 19, but rather after the 19 valuation when we do the experience study. So any substantial change in the pay grades, pay structure, how quickly a member move through the ranks, they will be reflected in the 2020 valuation. So it's a very long process. A has to do with the experience, B has to do with the changing of the assumptions to keep pace with the experience. And then, as is always the case, there's a 1-year delay. I'm looking back on page 47 of the report. There's a 1-year delay between the date when the contribution rates are calculated in the valuation and when it becomes effective. So in an environment where the contribution rates are going up, such as was the case in the 2017 valuation, you have a little bit of a actuarial loss because the contribution rate paid for by the employer is still lagging. On the other hand, it's the case with this current valuation because the contribution rates are going down. And so effectively what's going to happen is the employer and as well as our members are paying at higher rates than what is required. If we can change the dial and change the contribution rate instantaneously the next day following the day evaluation. So in this case, what we expect to see happen in the next valuation is a gain instead of a loss of the $2 million. And then, like I said earlier on, there's a loss due to the inclusion of the $1,000 death benefit. So that's the one-time only increase in the liability of about $549,000. And it's always the case, there's always some actuarial gains and losses. And in this case, it's a rather small amount of about $211,000. So net, on a net basis, the increase in the unfunded liability is $9 million. So you can almost say, in a very simplistic way, that the reason why there is an increase in the unfunded liability of the plan is because our active employees, our active members are getting salary increases which are higher than the assumption. But that particular impact is mitigated to some extent because we have a favorable, very favorable year on the investment front. Okay. So then rather than to go back to the very beginning of the report, I'm going to actually only ask you to turn to page 20 of the report for me. So it is section 2 on page 20. Because I just like to walk the board through how that increase in the unfunded liability, how that actuarial experience during 2017-18 has translated into a contribution rate change for the year. So on page 20, if you go back and take a look at what the rates were that the board has approved in the 2017 valuation, that contribution rate was roughly speaking 34.68, call it 34.7% of payroll. You will see, and the contribution rate that we are recommending to the board for this valuation has actually come down to 34.27% of payroll, and I'll explain why in a second. But most of the items that we were looking at just a minute ago on the unfunded actuarial, the accrued liability, why there's that change or increase in the unfunded liability has made its way onto this page. There's only one item which is very key, and we'll talk about that in the next minute. We have already talked about the need to increase the contribution rate because we are putting in for the first time the value of a $1,000 death benefit. That's the 6 basis points, 0.06% of payroll, or $41,000. There's a 1-year delay in implementing the contribution rate, and we have the effect of the investment gain because of even after going through asset smoothing, and so we also have the impact of higher than expected salary increase. And then last but not least, on item 6, we have the effect of other actuarial experience. So all that item we have already looked at on page 47, where we look at the change in the unfunded liability. Now, the only item which is new, which is very key, is on item 5. So this has to do with the effect of amortizing the prior year's UAAL over a larger than expected payroll base. Now, every time when we talk about salary increases given to our active members higher than expected, then you would expect, oh, so that means the contribution rate for the plan has got to go up, right? Because after all, the pensions tied into how much salary the active members are going to get at the time of retirement. Now, in this case, an active salary increase actually can help at least mitigate the rate increase somewhat. And this has to do with the fact that in the valuation, when we develop the contribution rate to amortize the unfunded actuarial accrued liability, we make an assumption that the payroll from 1 year to the next for the employer, including the county and the court and the cemetery district, will increase at the rate of 3.5%. So we take the amount of the unfunded liability, figure out how much we need in order to pay off that unfunded liability, and express it in terms of the payroll, assuming that the payroll will grow at an annual rate of 3.5%. So anytime when the payroll actually grows at more than the 3.5% assumed rate, so imagine that you're taking the same amount of the unfunded liability, more or less, even though it's increased a little bit because of the higher salary increases, but you're spreading that over a much bigger payroll base. So I think in this case, for this year, the payroll has gone up by almost like, was it 9%? About 9%. So everything else being equal, you can see that you're taking the same amount of, you're taking the amount of the unfunded and spreading that in terms of a payroll increase which is almost 2 times bigger than the 3.5% that we assume. So on a net basis, even though there's still a contribution rate impact because of ISR increase, but it's mitigated to a very significant degree because we have a much higher payroll base. So that's really the reason why, unlike the change in the unfunded liability when salary increases, has an impact on increasing the rate. But in this case, that salary increase has buy down to a very significant degree because of we have a much bigger payroll base. So in this case, because we have an increase in investment value, which is much greater than 7%, so everything when taken all together has caused the contribution rate for the plan to go down by 0.41% of payroll for a net savings of about $278 million. Now, one can argue that, well, we are really not looking at a reduction in the dollars because after all, you just said that the payroll has gone up by 9%. But if we deal only with a percent of payroll basis, that rate has gone down, although the rate is now applied to a payroll, which is arguably has gone up higher than what we expected last year. So at least in terms of the rate, it's very difficult to answer the question, has the cost for the plan gone up or gone down this year? I think the answer is yes. It has both gone down because the rate is decreasing, but the dollar amount is going up because the payroll base is much bigger than it was last year. Okay. Questions? So while we're at it, why don't we flip over to page 21? So 21 is where we try to do a reconciliation of the interest rate. So this is one where I have to double check with Dirk, make sure that we got it right. So it's really very little or no rate impact for the members. So as the board may be aware, the contribution rates for the members are calculated, driven primarily by the actuarial assumptions. So in the year where there's no change in the assumptions, interest rate remains the same as 7% of members. Continue to expect it to live as long as they were last year. You don't really expect to see too much of a change in the members' contribution rate, and that's exactly the reason why there's really no change here, and I would strongly expect that next year's rate would not change too much for the members either. All right. So now I think I'm going to realize that I've forgotten to, when I go through the unfunded liability, forgotten to walk you through the amortization schedule and explain why, what happened, even though the county has continued to make its contribution payment on time, why the unfunded actuarial accrued liability has only gone down a little bit. So with that in mind, may I ask you to turn to page 48 of the report. So now I'm looking at section 3 under Exhibit J, please, on page 48. So there's a portion of the unfunded liability which is calculated for the general. There's a portion that is calculated for safety. Now, if we flip to the following page, there's also an amount calculated for our probation members. So I'm actually going to ask you to take a look at the bottom of page 49 where we have the total. So I think it was back in 2012 when SEGO actually has performed a comprehensive review of the actuarial funding policy for the board. And one of the principal elements of the policy is the amortization policy. So anytime for a system like ours where we have an unfunded actuarial accrued liability, when the assets in the plan is not sufficient to pay down the liability, we have to come up with a payment plan, so to speak. So the board's policy back then was to take the unfunded liability and basically amortize it and pay that off over 27 years. As a matter of fact, back in the day, anytime you have any actuarial gains and losses, instead of setting up a so-called new layer, which is what happened after 2012, you would just add to the original amount. So the principal disadvantage of having just a single layer amortization policy is looking at the report today, we really cannot tell without going through a lot of research as to why we have an unfunded liability of about 134 million. So I'm looking at the total combined base. Or 126 million is the initial amount, 134 million. The only thing you know is that's the amount of the unfunded liability that have yet to be paid off, and how much is the payment amount, which is 9 million. But you have no way to tell Is that because, is that unfunded liability created because the actuaries were wrong with the actuarial assumptions, or is that because of investment gains and losses, or is that because of change in the actuarial assumptions? So as a result of that review that took place in around 2012, the board approved our recommendation to actually now do the unfunded liability by layers. So after 2012, you really can tell exactly why the unfunded liability actually has gone up. And you get the valuation year, you have the explanation. So for example, after 2012, there was an experienced loss, and that increased the liability by about $3 million, and the payment associated with that. Now, instead of looking at the numbers on the chart, I actually like you to look at the new page in the report, which is coming right up on page 50. So this really can tell, because you're looking at a color copy, you really should be able to tell exactly why the unfunded liability came about since that restart. Now, in this case, because the restart is basically half of the total unfunded liability, so that's the red bar. But if you take a look and see what has actually happened since that 2012 restart, then you can see that, well, a lot of the unfunded liability was actually added somewhat deliberately by the board when the board changes its actuarial assumptions. So you may remember under our watch, we have recommended and we have accepted our recommendation to reduce the investment return assumption several times. Last time that happened, the investment return assumption was reduced down to 7%. So this is the no good deeds will go unpunished scenario, which is every time we reduce the investment return assumption, we have to remeasure the liability, which increased the amount of the unfunded actuarial liability. But that actually put us in a somewhat more favorable position because now our market return target is only 7%. So it meets, number one is, for some critics of the pension plan, may say, oh, it's more realistic, or maybe it's more easier to obtain. But in any event, if you look at the length of the bar, starting from the left-hand side, you can see that with the exception of the original restart layer, basically the bulk of the unfunded liability that was added since 2012 or 2013 or thereabouts is as a result of actions taken by the board to adopt more conservative actuarial assumptions. Otherwise, the actuarial gains and losses, salary increases coming in higher than expected this year, or salary gains coming in lower than expected for the last 5 years, they kind of mitigate or offset each other. So that's the nice thing about having a graph like this is you can see exactly how the unfunded liability came about. Now, another reason why this is important to have a chart like this in our report is it actually shows the board how quickly the unfunded liability would be paid off. Remember I said early on, even though the county has been making the payment to the unfunded liability, but the amount of the UAL has actually gone up. So the critics of the pension plan may say, well, exactly when will this huge amount of unfunded liability be paid off? And this is actually proof that it will be paid off. Everybody will have to have a little bit of patience, but it will be paid off and over time. Now, if we look at the following page 51, so now we know that the unfunded liability will eventually be paid off according to the schedule. But the question is, at what cost? How much would be required for the employer, the county, the court, and the cemetery district in order to pay down that unfunded liability so that it will go away in about 2038. So this chart will show how much the payment is today, as well as the payment for the next almost 20 years. Again, the payment amount expressed as a level percentage of payroll, assuming payroll will grow at the assumed rate of 3.5%. So that's the reason why the payments, at least all the way up through about 2031, is expected to continue to go up. And the reason why they will go down eventually is that's when some of the assumption changes, layers, will drop off from the list. So those are some of the assumption changes that were put into place before the 2017 experience analysis. So now you have it, how the UAAL will be paid out, how much will be the payments required to pay down the UAAL. Okay.
Question. So on 48 or 49, you have this chart of the annual changes and the initial years, and all of them say 18. Now, where do we get to see the different payback periods that we adopted? There was
Some are
one,
5, a couple.
some are 5, like I think decisions by the county, and maybe that's a change in benefits, were 5 years, and so forth. So then we had another tier of payback, and I didn't see it in here. That's not in here at this time.
Correct, yeah. The reason why that is the case is, for example, if you're talking about the pension reform legislation that was passed in the year 2013.
Well, that too, that's part of it too. So the specific I'm looking at here is you guys estimated 204 million to be this year's unfunded liability, or was it 203? Anyway, the numbers are smaller.
Right.
The county increased payroll by nearly 6%, and then due to the deferring of implementing the new rates, it goes up to a total of 6.8%, which everybody will blame us for, that the unfunded liability goes up. So the other part of this is, if that's an action of the county, where is that $11 million stuck in here at a 5-year amortization rate? Does that make sense to anybody but me?
If I may, Mr. Chairman, I think, so what you're referring to there are the different amortization periods we have for our layers.
Right.
Yeah.
And there is one layer that has a 5-year amortization period. And that, I believe, is specifically if the county does an early retirement payout. That has, if that happens, then we have a 5-year amortization on those contributions to the UAL. But the county has not done that since we implemented this policy in 2013.
Okay, so I got real specific by saying 5%. There's different tiers. And is this increase of a county action, increasing payroll and deferring implementation, one of those tiers different than 18 years? So,
No.
No, in that
Okay.
case, it's also considered an experience loss, actually experience gains and
okay,
losses.
your experience loss,
Right,
okay.
right. So this could happen, for example, if active members are getting salary increases which are too high.
No, I totally understand what you just said, that it's in this 18, it's under experience loss.
That's right.
And so I guess the other point I'll make and then stop is this increase in the unfunded liability is not due to us doing something as a retirement board. I just, for the public record, where the camera is, it was a decision made to try to keep employees by the county of Mendocino. So,
Andy, looking at the chart on page 51, annual payments by whom? Is this chart that I'm looking at, is this the county's contribution?
has to be.
Or does it include the employer or employee portion as well? Or is this chart specific to the county?
Yeah, it's specifically to the employer, the county, the court, and the cemetery district. And the reason why that came about is based on our understanding of the 37 Act. Anytime we have an unfunded actuarial accrued liability, that payment can only be paid by the county. So likewise, if we have an actuarial gain, so for example, if we forget about the fact that we still have some unfunded liability, but if we were to exceed our assumed rate of return of 7%, like we did this year, forget about all the past unfunded liability, that would have the impact of reducing the employer's contribution rate. And in that scenario, only the employer would benefit. The employees will never share in any actuarial gains. So for that reason, they never share in the actuarial losses.
Understood.
I have one more question about these charts. So the chart on 50, and it could also include the chart on 51. If this had been at the rate you estimated, the 203 million, would this right-end date of 2038 actually be 2037? Because we would have something like $11, $12 million less to pay off.
Now, the reason why, I think the answer is no, it will still take about 2038, is that that's the length of time with the longest layer.
Okay.
So that's when
The county would just be making lower payments.
that's right. So imagine on page 50, there would be a lot of greens at the bottom,
Yeah.
which are the negatives. So it would pull down the contributions, but nonetheless, it would not shorten the time period to pay down the fund liability.
God, so the net would be, the county portion to pay this for the next year would have been lower.
That's right.
Thank you.
So just going back to the front of the report one last time, because it's actually a FYI kind of an item. So I'm wanting you to take a look at section 1, or maybe before we go to this page, just want to always provide this informational item to the board. So this is on page III. So this would be section 1, Roman numeral 3. So this is a section of the report that we've been including for the past 10 plus years, not just for MSERA, but for our other clients. So the question is, especially the question was, right after the 2008 recession, 2009 recession, housing bubble crisis, when we were using this asset smoothing methodology, that has the impact of basically back then anyway, of deferring a significant amount of the actuarial, the market losses. So the question is, are we really hiding the losses, right? Because you use a value of assets back in those days, which are substantially higher than the true market value. So we have added the items which are at the bottom of page III. In response to that, though, no, we are not hiding, because as a matter of fact, there are a couple of places in the report where we make mention of the fact that if we were to use market value back in those days, the funded status of the plan would have been a lot worse. The contribution rate requirement would have been a lot worse, would have been a lot higher. But the flip side would be true. So in this case, I keep going back to the comment I made at the onset of this presentation. Because we haven't spent the entire 9+% return, for example, for 2017-18, in reducing the employer's contribution rate requirement to the unfunded actuarial to accrue liability. As a result, we are now sitting on a pot of money of market gains of about 10 million that we have not yet recognized. So the question is, if those market loss gains were to be recognized immediately, which we would not recommend, how is that going to impact the funded status of the plan as well as the contribution rate requirement? So I'm just reading to the board the items that we have provided at the bottom of page III. That funded status would have gone up from about 70.4% to about 72.5%. The contribution rate requirement calculated in this valuation actually would have come down from the 34.27%, which is our recommendation calculated with their smooth value, to about 32.4% of pay. So this is one where if we were to take the $10 million plus gains, recognize all of that immediately, it would have a very significant impact, because the employer's contribution rate would have almost gone down by 2%.
Mm-hmm.
Now, you can argue what we have heard Cal and Greg talk this morning, that just for the month of October, it sounds like we have lost about 20 million, so maybe that some of the money have already been spent already. But nonetheless, we would rather be sitting on deferred gains as opposed to deferred losses, going without saying. So this is our rainy day fund, something that we hope that we would not have to call on in the next valuation, but at least we have a little bit of a cushion that have been set aside.
Good.
Okay. So now, last but not least, just a wet FYI. So looking at just something that needs to be included in our next valuation. So I'm looking at the next page, Roman numeral 4, page ID. There's a new actuarial standards of practice, the ASOP, so to speak, on risk assessment. So this, under this particular actuarial standards of practice, we as your actuary will have to make some recommendations to assist the retirement board and the other principal stakeholders in understanding the risk associated with running our retirement association benefit programs. It is really up to you're actually in consultation with your staff and the board to determine what is worth looking into. So the board may remember a couple of months ago, you have started the project to answer the question, well, what if we did not earn the 7% assumed rate. So for example, if we were to earn 0%, or maybe to make it more balanced, we earn 2 times as big as the 7%, meaning a 14% rate. How is that going to change the employer's contribution rate? How is that going to change the unfunded actuarial accrued liability of the plan? So it is really with that spirit of including some of these what-if scenarios that this kind of risk actuarial standards of practice came about, because we don't want the stakeholders and principals to think that the plan is always going to behave as per the actuarial assumptions. So we want to make some illustrations, not predictions, but illustrations as to how the funding of the plan may change either on the upside or the downside if some of the assumptions were to be coming less, either more favorable or less favorable than expected. So this is really something that is not required this year, but something that you would hear more and more from Seagull, and maybe even when you go to the Secretaries Conference. So for those of you who have signed up for next week, you will hear more and more of the trustees starting to talk about, because starting next year, after the June 30, 2019 valuation, that is going to be part of the required disclosure. Under this particular ASOP, we're not required to do a lot of number crunching. It is even permissible for us to just say, well, if the investment return were to go up, contribution rate requirement will go down. Believe it or not, that would be sufficient disclosure, although we would not generally recommend that to our client. I think that it is worthwhile to put some number crunching behind so that all the stakeholders would be better able to understand what are some of the risks, especially associated with the investment return not being met. But in any event, that's really coming attraction for the upcoming 2019 valuation. So I think with that, Mr. Chairman and other members of the board, this conclude my prepared remarks on the funding valuation. I know that Dirk is anxious to talk to you about the gas fee report, but this is really the high-level summary of the results from the funding valuation.
Do we have any other questions, James?
I'll defer if there are any trustees with questions.
I have a question, just, it goes back to the issue of reciprocity, which I know I'd asked a few questions about before. I'm just wondering how much of an impact it could have in the future if the average salary in Mendocino County is considerably lower than other counties where people go to. Because what I saw in the past, it looked like Mendocino County 10 years ago wasn't as far apart from, let's say, Sonoma County. That wage gap over time seems to have about doubled from what I saw in the state data. So when the final average salary is calculated, in the past it might not have had the same level of impact. So I'm just wondering if there's any way to account for that, or how do we know what kind of impact that could have going forward?
Dirk, want to address that?
Yeah, it has not been measured. Our current assumption is that people will go work for a reciprocal employer and get 4% increases in salary per year. So to the extent that there's higher salary increases that they actually experience, and obviously the liabilities will increase. As it stands now, current terminations, including deferreds who are not working with a reciprocal employer and reciprocities, account for about 5% of your total liability, just for the current population of inactive vested members. Future inactive vested members, again including deferred non-reciprocal members, are about 0.5% of your total liability. So those numbers will obviously go up if your future pay increases go up for the reciprocal employers. We have not measured that. It is something we can do by changing the future salary assumption, but those are the kind of numbers that we're looking at this point.
Okay, and that impact comes just on phone. It would ultimately, if there was a discrepancy, that would end up in the unfunded liability?
That's right.
Okay.
Yeah, because when the benefits are ultimately calculated as a retiree, they'll be based on that others, in this case Sonoma salary, which will be higher than what we had expected all along as a working member or as a deferred member.
Okay.
And if I may add, we have taken a look at that at one of our Southern California county over in Imperial, because coincidentally, we have a lot of folks who left El Centro to move north to work at San Diego County. So it was true that when we look at the salary discrepancies between El Centro and what's paid in San Diego, every time they cross the county boundary line, salaries increases by almost 30–40%. So what happened at that particular system is they now have a process set into place rather than to wait until the unfunded actuarial the accrued liability show up in the valuation. We actually are now proactive. Every time we know of a member moving from one system, which coincidentally is one of our clients at Imperial, to another client of ours at San Diego, we immediately increase the liability accordingly. But that would require us working with the retirement office to basically obtain that salary. So right now, the only thing that we obtain whenever we have one of our employees, for example, move from here to another 37X system, is a indicator on the file indicating that this member is now working in a reciprocal system. But in this case, it sounds like it might be interesting for us to not only know that this member for sure is working for a reciprocal system, but what kind of salary the member is getting from that reciprocal system. So I think we can enhance or improve the accuracy of our valuation and not wait until the liabilities show up at the very tail end. If we were to have a process to collect those salaries for the reciprocal part. Maybe you don't need to do that for all of your reciprocal employees, but maybe at least for those that you know of have moved over, for example, to Sonoma County.
So to recap, you're saying that the built-in assumption is that when someone transfers to a reciprocal agency, they're on average, they're earning only 4% more than here.
Each year.
Yeah, but more than 4% here.
That's
than
right.
Here. And in all, well, many of us in the room may assume it's much more than that.
That's right. That's right. Yeah. So, but it does not happen to a lot, to all of our, for example, 12 county retirement systems that we work on. Of those 12 systems, we only have that a review of the salary collection, the compilation of the salary made by one county at one of the board meetings when one of the board members expressed the same concern.
So what if in our case, the average transfer difference was 8%? So I know it's a fraction of the employees that will transfer out, but it's still a noticeable number.
Yeah. Yeah, I think once we collect the data, validate the data, we certainly can build that into the contribution rate setting process. Instead of waiting until, let's say, 20 years from now when the reciprocal employee finally retires from, for example, Sonoma County. We can do that now as opposed to wait 20 years.
So the other question there, though, is that's Imperial to San Diego. If it's not Imperial to CalPERS or anything else. So there's still a lot that may not be being captured in that.
Yeah, as a matter of fact, my understanding of the process at Imperial County is they actually ask all the systems who would care to respond. So the letters are sent not just to San Diego, but to all the other 37F for sure, maybe even to CalPERS. CalPERS may not respond, as some of us in the room may know, but at least we try the best we can to reach out as much as we can.
Okay, great, thank you.
Did you have another?
Yeah, I was gonna say what I think was interesting about Mendocino County and what originally made me wonder if we were in a different spot was because our average salary is, I think we are the lowest of the 37 Act, or we're the second or third lowest.
Imperial, definitely.
Yeah, so when people leave here, they're almost, at least anecdotally, what I've seen, everyone's going to a much higher paying salary job. Whereas in other counties, I think there may be more lateral transfers going on where you're keeping an equivalent salary, or maybe not everyone's going up. Whereas here, I think generally most people leaving are having a pretty high jump, which is what concerned me. So.
Because they're not going to Lake.
Oh yeah, that's. I mean, basically everyone I know took, like a 20% jump when they left. So that's.
Yeah,
just want to make sure there's not a whole.
I can't imagine many people are leaving and only getting a 4% increase.
Exactly, and that's, so I would love to see if there's anything we can do to get more data on that.
They do fill out a form when they leave here, right? Because they leave their funds on deposit if they're going to a reciprocal system,
Yeah, we have to establish reciprocity.
right out of the chute. And then it seems like the other issue is a lot of those are probably safety members. I mean, I don't know what that percentage is, but it seems like there's a lot that are safety, which has a higher benefit, higher, it's just more expensive in the system.
So who is it that would collect that data? Is it the retirement association? Is it the county?
Yeah, in that other case, it's really the retirement association, the staff who would be reaching out on a periodic basis. You may not need to do that every year, but maybe every 3 years to make sure that the jump not only take place, for example, at the day of transfer, but maybe subsequent to the day of transfers, and sometimes it's very difficult to predict. On the one hand, you can argue that, well, the existing salary increase assumption we have for Mendocino would be sufficient, but if promotions happen a lot quicker at the other county, you want to also capture that, and so for that reason, that other system has a practice to look at the salary increases every 3 years. So they don't do that every year as they used to, because we share with them that you may not need to do that frequently, but every 3 years before the experience study may not be a bad idea.
So to clarify, you're saying that they do follow-up, so someone transferred 10 years ago, then every 3 years, you're still contacting to see, because they may have seen other promotions, not just their initial pay at the agency.
Correct. Yeah.
Okay.
Well, and they could have gone from Sonoma County to Marin County.
That's
And
right.
I was just curious, like if Judy, if they contact you, if they change again, they just have to notify you once on reciprocity when they leave, right? And then it's, when they leave Sonoma, then they have to notify Sonoma, they're going to Marin kind of thing. So, yeah, so we would have to check with that individual and find out what they're doing.
Right, and if it's outgoing reciprocity, we don't know if they're still working or if they discontinued working in some cases.
That could be just a question on the exit interview, I guess. It's like, oh, you're leaving, are you gonna work somewhere?
Oh, well, that would be the county, not the
Yeah. And then I think your point is very good, is the possible promotion as well. I mean, if somebody leaves here at 10 years and they work another 20, they're likely not only get 4% a year, but a change in job description and salary range and everything else.
Someone retires as a deputy department head.
Yeah, and so capturing it at 4% a year gets something, but it doesn't seem like a lot. Interesting.
So I think it'd be helpful if we could have that information, but I don't know.
Or
Who's
can
gonna
we-
gather it?
Or can we just increase it from 4% to 10% or whatever?
I think we could. The only reservation I have is to base it on
Data.
Data.
Yeah.
Based on data.
That's why you guys are the actuaries, you know.
But
You have all the
no
numbers.
dartboards.
Yeah. Well, once you give me the data, I can keep the percent.
Sure, it's 5.79.
So
Just got that.
Patrick did initiate a conversation with me, and then we engaged the actuaries discussing this issue, and they've apprised us that Imperial does this process, and we have a plan to do something similar with the next valuation, with all of our spare time.
Yeah.
Sorry.
Well, we've done that once in the past already, yeah.
Okay.
The information does lie in our annual data request, just as a reminder if that trips any memories.
Okay.
Okay. Shifting gears. Earlier this year, we reviewed the actuarial funding and practices policy. But since that time, a question has come to my mind. Could the board take a step in the actuarial funding policy to move in the direction of more conservatism and shorten our layers even further than the 18 years to something like 15 years? And is anyone else thinking about that? I would not want us to do that in a rash type of way, but it could be something that we could consider as part of the next experience study. Give me your kind of off-the-cuff thoughts of that, and I apologize for not pre-warning you this question.
No.
I just thought of this as we were talking about layers earlier.
Yeah, I think the short answer is yes. A lot of our other 37A clients have gone through the same policy review for funding policies, and around the same time, as you can imagine, we typically try to take one good idea, review of actuarial funding policy, and promote that among all our 37A clients. So all of the clients have about 5 6-year timeframe to review all their policy, including the funding policy, in a comprehensive way. So as part of that discussion, some clients are feeling uncomfortable, especially if they have amortization period, let's say longer than 20 years, for example. They say, oh, well, why don't we bring it down? I think for clients like ours, like MSERA, where you have an 18-year policy, it's kind of like a sweet spot, so to speak, because it's not so long as to create the so-called negative amortization. That is where the interest charge is even greater than the payments that are being made to pay down their unfunded liability. So for a system like ours with an 18-year, it kind of a sweet spot. You may or may not need to change it in a major way, but definitely the idea is to bring the plan into full funding sooner rather than later. Then shortening the amortization period would achieve that goal. But more importantly for our plan, because we still have a very significant, a very substantial amount of that restart layer with a 21-year amortization schedule. So I think if it were to be the concern or the interest of the board to basically bring the county or the retirement association into 100% funding sooner rather than later, perhaps the way to look at that would be to look at that original layer. Right now, that layer won't be paid off. Remember the lot of red that we were looking at on some of these graphs, it won't be paid off until 21 years. So the question is, what could have happened if that unfunded liability were to be, the layer were to be shortened to something like 15 or 18? What could be the contribution rate requirement? Is that something that the board would be interested, or would the employer have the appetite for the higher contribution? So we are really going through a lot of the discussions, especially with our clients that have this layer approach, and there's a significant amount parked in this original layer.
So one question I have is, if we have a year where for market returns, the employer contribution was to go down, what if rather than going down as a percentage of payroll, it just stayed at the same percentage, and you took that extra allotment and applied it to the original principal?
That's right, and I'm glad that you raised that point, because we have actually clients that decided to do that, and I'm going to go back to Imperial County again for 2 or 3 years in a row. We have been recommending reduced contribution rate requirement for the Imperial County Employee Retirement System, and they said, well, sounds like investment return is going to be problematic because it's going to be ups and downs. Why don't we ask the employer to continue to pay the same higher rate instead of giving them a temporary relief, only to take all of that back plus some in the following year? So for that reason, that approach, even though it is a little bit ad hoc, has been practiced in other places, and Imperial County is a very notable example because we have done that several years in a row.
So what authority do we have to make that recommendation to the county, or at least create that option? Because right now we just adopt the rate.
Yeah, my understanding is that at least based on my discussion with our other client, is that the retirement system would always like to follow the actuary's recommendation, especially if the rate is going to go up. But in this case, because you just want to stop the rate from coming down, so in which case you're just utilizing the additional contributions to pay off the unfunded liability faster. So at least from my discussion with the other retirement system, it doesn't sound like there's any prohibition at the other jurisdiction when they look at the law, but clearly I'm not the authority, and Jeff here, so we need to ask Jeff that question to make sure that asking the employer to pay a higher rate is not a problem.
So it's always kind of a delicate dance, right? I mean, when the board decides, when the board decided to go from wherever you were at 1.8 all the way down to 7, obviously that impacts the county, but the determination is made here. And so if you're wanting to be more conservative, that could be something that the Board of Supervisors doesn't want to do. And there's always a tension there between, who makes this final decision. We approve this report today, and we tell the county, these are the rates you have to pay. And they do. If they wanted to object for some reason, I think you'd have to be really going at an extreme clip to give the plan sponsor the ability to make a legal claim that we're not going to follow that. It would have to be kind of a reasonableness test.
I was not proposing a requirement, but here's an alternative. If you were to pay the same percentage of payroll, this is what it would be. The board recommends this, but we're still adopting the standard formula per, as a,
So if you want to float something and see what and get their thoughts on it, I mean, you can certainly do that. I thought your question was more like, if this is something we decide, can we force it on the Board of Supervisors?
I was saying we adopt the recommendation, but we further recommend that they keep the percentage, and this is how it would play out if they applied it towards the principal.
So it's optional?
Yeah.
Sure. I mean, that's easy. Going the other way, I mean, what if you wanted to change from 18 years to 3 years? I mean, that's such a monumental change. You see what I'm saying? If you're, I won't give that hypothetical because it's a difficult answer. Your question is easy. You're making a suggestion. They can decide to do what they want to do with it.
Because it would just be part of the overall budget process. It would be a consideration. It's not.
Yeah, that's certainly something that the board could do. This board could do.
Yeah, I mean, we're acting as legal advisors to the county for a debt when we do this. This is not our responsibility. So it's up to if you want to make an extra mortgage payment this month or this year, it's like sell it to your cohorts.
Yeah, I think, I think we understand it's very good motive, but sometimes there could be some complications. Now, if I may ask the board to look at page, section 1, Roman numeral 5, page V. So it is absolutely true that so I'm looking at page V, Roman numeral 5, on a employer by tier basis. Just give me a minute to get to that page. So whereas it is true that the contribution rate that we're recommending in this valuation has gone down for all the tiers combined, right? Because after all, we say the rate for this year coming out from the 18 valuation was 34.27%. Last year was 34.68%, so the rate has gone down by about 0.4%. But if you now look at the rate on a tier by tier, membership group by membership group basis, it is true that for some of the tiers, on some of the membership group, actually the rate has gone up. So in total, the contribution rate has gone down. So in order for the suggestion or the discussion at this board to follow actuarial principle, we now have to propose to the county or recommend to the county that they pay the greater of those two rates on a tier by tier basis. So that's one small complication, something that can be overcome, I'm assuming. Because, for example, if I look at the rate for, let's say, tier 1 general, I know that there cannot be that many tier 1 members left in a general tier 1 plan because the contribution rate amount is only about $200,000. But nonetheless, the rate has gone up a little bit from 34.39% to 34.41%, whereas there are just a lot of rate groups where the contribution rate has come down. So that's why the average is coming down. I think the other part of the complication, not something that cannot be overcome, is if we give this option, for example, to the employer to make the greater of those two payments, I think the question that may be asked is whether or not we would make this option be available on an employer by employer basis. Because the last thing that we want to avoid is for the county to say, yes, I want to make payment to my unfunded liability sooner rather than later. But then if we now make it an option, for example, for the court say, oh, I don't want to do that because I don't have the money. I don't have as much money. So then now we create a little bit of a problem because, as you know, any time we have an unfunded liability in the plan, especially in the general membership category, any UAL is paid for shared among all the general employers. So the last thing we want to do is to create some kind of inequity. If the court decides to not take us up on our offer to pay down the UAL faster, but the county does. So now we have to keep track of exactly how much more the county has paid in order to make sure that all that additional contribution would go towards the county, but not to the court, for example.
Okay, Sharon.
I like your idea of the base, of lowering that amortization on the base, instead of going like from 18 to 15 years, taking that, and, I mean, like, so it's 21 years, even lowering it to 20 years, and doing it very gradual and seeing how that affects the rate. I like that. I think that would be, I think that would be a good way to go about it. But do it, especially at the beginning, just do it like, you know, just to a minimal, I mean, just do it, and then see how it goes. And then that would be something that we could, and then work, and then afterwards, once we get that down to equal these other ones, then start looking at lowering it to 15. I think that would be a way to attack this.
I think the only question is on the timings. So, for example, we have the whole valuation report prepared.
Yeah, well, maybe even next year.
Yeah, maybe next year. Yeah, I like that answer.
Yeah.
Well, it sounds like that's a better strategy than
What?
Yeah, well, I mean, but that's just something for us to think about. We were never at this point before. It felt like.
I started talking about doing this at the next experience day.
Oh.
That's where I started the conversation.
Yeah.
Just to remind everyone, this is not a policy decision this board should make today, in my opinion, but it's helpful conversation for us to have, and it gives staff and the actuaries some sense of the position of the board, and we can go and do some further research and work and consider this as we move forward. So.
And as part of the consideration, I mean, you can run ideas past the county and the other plan sponsors, and that can be a factor in your decision.
And so, Mr. Chairman, I think it would be appropriate at this time if the board is interested to adopt the June 30th, 2018 actuarial evaluation report.
So moved. Second.
Any more discussion? Just all those in favor?
Aye.
Any opposed? So now we're on to the exciting item, which is GASB 67.
Andy took you through the funding report. I'm going to take you through the GASB 67 report, which is for financial disclosure purposes. Probably have you start on page 4.
Yeah, so it's also in the hard copy. If you follow the hard copy, there's a tab at the very last tab called GASB 67. So this is the last step in the blue binder.
So, section 2, page 4. So just to give you a few terms, this shows you a snapshot at June 30, 2018. The first line on the table on that page is total pension liability. That's essentially your actuarial accrued liability in a funding plan world. The next line is planned fiduciary net position. Those are your assets. The difference between the funding report and the GASB 67 report is for GASB purposes, we have to use market value of assets. So the planned fiduciary net position is your market value of assets. And then finally, the net pension liability, that's the difference between your total pension liability and your planned fiduciary net position. That's equivalent to the unfunded accrued liability in your funding world, but on a market value basis. So you'll notice that net pension liability moved up from 195.5 million in 2017, increased by about 2 million to 197.5 million. Not going to take you through each of the reasons. They're listed out on page II. Some of the bigger reasons why. All of those Andy has already discussed, talking about the change in the salary gain loss that increased the liability significantly. The inclusion of the $1,000 death benefit, some of that was offset by your asset gains on a market value basis. And then one other item that we will point out, in the past, the total pension liability and the actuarial accrued liability had been the same figures. We have a footnote on the bottom of this page that we made a small refinement to that process this year. You have some employees working for Mendocino that they've upgraded their service to the formula under section 31676.12 of the 37 Act. Before the upgrade, they were under a lesser benefit formula. And so the refinement that we made was to actually track their past history and to calculate the benefits under each of those separate benefit formulas. In prior years, your normal cost and was determined based on your ultimate improved 31676.12 formula. And so it's important to note that this refinement does not change the entire present value benefit calculations. It just changes the distribution to what's allocated to your total pension liability or your kind of past service liability and your future service liability. It just moves the bar, but it doesn't change the total cost. So that had an increase of about $500,000 to your, we'll call it TPL, your total pension liability this year. Also on page 4, it provides a funded ratio of your assets to liability, and that's moved up from 71.2% last year to 72.5% this year. That should be no surprise because Andy already gave you that information in the funding report. Just moving forward a little bit to page 6. This basically shows you how we got to the beginning, from the beginning of the year numbers to the end of the year numbers for both the total pension liability and for the assets. It gives you each of the items that get you from beginning of the year to end of year. An additional piece of information, it takes your unfunded liability or your net pension liability on a market value basis and expresses it as a percent of covered payroll. Covered payroll is defined as basically the actual payroll over the fiscal year. It's the amount of payroll on which contributions to the pension plan were collected. One additional piece of information, sorry to have you flip back and forth, but if you move back to the bottom of page 5.
Jason Island.
Is my time up? Bottom of page 5, we had previously mentioned that the NPL, or kind of unfunded amount, was about $197.5 million. That was measured on the same actuarial assumptions that were used for the funding report. Here we show sensitivity analysis of what would happen to that figure if you simply change the discount rate up or down by 1%, down to 6%. Obviously raises your unfunded liability, or NPL, and a 1% increase in the discount rate decreases the NPL. I guess the last piece of information I'll discuss is on page 9. So is this a projection of your plan's fiduciary net position to show how there will be enough money to pay all the benefits? And so this is just a run out of contributions, benefit payments, earnings, etc. And this is, I guess, proof that the 7% interest rate is sustainable. So,
I think one item is noteworthy on page 9 is just exercise that we are required to go through by the Governmental Accounting Standards Board to prove that the assets in the plan, together with future contributions, will be able to make all the benefit payments. I think for all the clients that we work on in the free second-hand community, that is always going to be the case. I think the one poster child, at least a couple of years ago, was the Cal STIRS, the State Teachers Retirement Plan, because back then we're not the actuary, but the actuary has always presented a bill to the state, which is higher than what the government is required or is wanting to put into the plan. So the actuary has been signing the alarms for several years before gas fee, which says, oh, you will run out of money to make those payments in about 30 to 40 years. So the teachers are not really sure what to do. And so finally, the state decided to increase their contributions to the plan. So I don't think that they run into this problem at all. But I think whenever we ask this question, so why do you put this chart in, it's always because of the required disclosure. So it's not going to be a very exciting story to tell because we have all the money to make all the benefit payments. So it's only when you go back east, some of the states that have not been funding their programs on an actuarial basis, those plans are expected to run out of money. So for them, this chart is going to look pretty ugly pretty fast because they will show in 20, 30 years time that the assets will become negative because they just don't have enough money to make all the benefit payments. But that is never going to be the case at MSERA, nor is that going to be the case for any of the 37 plans that have been funding on a full actuarial basis.
Wasn't some of that also states or entities that when you got health care when you retired, that had not been funded at all?
That is a problem area as
Pay
well.
as you go.
Absolutely, yeah. So under the, thank you, Jerry, for bringing that up, because there are some plans even offered by, or not run by the retirement association or retirement boards, but run by the county elsewhere, where they have not been fully pre-funding the liability. So for those plans, they would have trouble passing this test as well. That's right. Thank you for bringing that up.
I get touchy when you get to CalSTRS.
She knows a little bit about that.
Okay, does someone want to make a motion to approve the GASB 67 actuarial valuation?
So moved.
Second.
Go ahead.
Any discussion? All those in favor?
Aye.
So now we're on discussion regarding MSERA unfunded actuarial liability educational.
Thank you, Mr. Chairman. Trustees, I'll remind you, while our actuaries are still here, there was a project on the board work plan to put together a one-pager on the unfunded actuarial accrued liability, and that is before you here in draft form. It was a struggle to get to contain this to a single page, but I managed to. There's not nearly as much detail as I wanted to put in here, but I was very strict on the one page. So I'd be happy to entertain any edits or suggestions that you have. If not, we'll make this document final and start public distribution.
Would this go on to the monthly newsletter, I assume?
This is not really drafted for the newsletter, but we might mention it in the newsletter and provide a link to it. Or maybe grab some paragraphs from here for the newsletter.
How then were you planning on publicizing it?
Primarily just the website,
Okay.
and maybe some distribution to press. Hadn't really thought that through yet. So, but it could certainly get a mention in the next newsletter.
So understanding that you could have easily made this much longer. I look at the two graphs. You have a bar graph showing the increase, and right next to it you have a line graph showing it dropping off. As an uneducated reader, you might say, well, how come it shows, this one shows it going up and this one shows it going down?
Different years.
As it's, well, right, one of it starts at the end of the other one, so what happened in 2018 or, and again, it probably takes another 5 pages to explain that. But I mean, it is, you know, you look at it and go, well, wait a minute, are they just saying it's gonna go away like that or what? Quick comment, but.
So there was some attempt to explain the increase from 2010 to 2018 in a paragraph or two. And, you know, the projection is I take those numbers directly from the actuary. And the thing that I say publicly when I show that the figure 3 graphic in my presentations is, we know the path will not look like this. Every year we get new experience, and it may be positive or negative, but the plan resets and we're continuing on the path towards 2039 and fully funded. So that's what I'm saying publicly. when I discuss and present this graphic.
And that's the wording right above it, basically.
Oh, forgot I wrote that. Or copied it. So, the one-page limitation was difficult to deal with, but I tried to get it down to one page, still having graphics that were readable in size, and yet cover the information that I felt needed to be covered.
So it's definitely factual, but it kind of misses the inverted pyramid that's in a news story, which is a number of reforms have been put in place, have shown a temporary increase in unfunded liability, but should increase the likelihood of paying it off with certainty by 2039. And then you kind of go through, because right now it's sort of chronological. It takes a while to get to that punchline.
Okay. I think about that.
What's the difference between the 70.4% in your first paragraph and the 72 point whatever in the report from Andy?
The 70.4% is from the valuation report, the June 30th, 2018 valuation report. And that's based on the 5-year smoothing of asset returns. The 72.5 is from the GASB 67 report, and that's based on market value.
Market value.
Yes. So I almost always refer to the funded ratio from the valuation report, because it is more stable over time. It doesn't get whipsawed by good or bad market returns. So.
Okay. Sorry, I may have missed it. What are we doing with this?
Website, public distribution. It was the one pager that the board asked for on this as a educational piece
And
for
so
the public.
the other piece with this was the pension obligation bonds, and I know that's the county's responsibility, not the retirement system. Wasn't there a one-pager on that as well? Were we gonna do one, or is there any reason we should try to incorporate them or keep them very separate?
I think they're very separate and
Which they
different
are.
topics. And we did have conversation about that. And it's not on the work plan at the moment. I know there was, I'd have to go back and look. I know there was some discussion about it, and I pointed out that it's not our issue.
Right.
So do we even want to talk about that or not?
Well,
But I think that's a, for lack of a better term, it's a policy decision of the board of, do we want to put out an educational piece about the pension obligation bonds?
Because I thought we talked that we were gonna do that, and then we decided later we
I think
didn't
that
necessarily want to
may
do
be
that.
accurate, but
Okay.
I'm relying on my
Because
memory.
it just feels like the whole picture is the pension obligation bonds and this. And I get that, they're very separate. The county's got the
Right.
POBs and we've got this, but still it is, the whole picture is all of it. And the other fact that those will be paid off in 2026 and we'll have money,
We will.
well, the county will have money, plan sponsor will have, good $4 million that they will then be able to, more than likely, that's where it will go.
Oh, it's $8 million here.
Well, it's 8 million, but I think only 4 million is the general fund, I think is what I heard. Sometime, I think it was when Alan Flora came and talked to us. It is 8 million, the payment's $8 million annually, but I guess only 4 million of that is actually general fund dollars. That would affect the general fund.
The rest is social services.
That's, I didn't know that until about a year ago, yeah. So that would be something though for the count, that is a good thing, a whole picture. If you want to look at a snapshot of our whole picture, it would be all that.
I would say if you need more space, and Richard doesn't like the bars and the lines, I would spend less time on talking about what's happened in the last 8 years. You've said a lot in the paragraphs. You could perhaps expand upon what we're doing over the next 20 years, rather than putting that graph in, because that graph doesn't tell me a whole lot.
I was gonna suggest we don't call it a one-pager, we call it a one-sheeter. Both sides.
There you go. I think we just went to 2 pages.
What size font is this?
There you go.
Change the
King
font.
size instead of twin.
After all that work, we're now into a one-sheeter.
It's a 1-sheeter instead of a 1-page.
I have worked on 11 by 17 paper.
There we go. You were doing that last night.
Size 6 font.
Oh, you did 11, 17.
Put extra copies in the bathroom.
Okay,
Good job.
well, I'll take these comments
Good luck. Try to figure them out.
and do some more work on this, and then we'll finalize it and put it out. So,
Thank you, James.
Alrighty.
Okay, that brings us to the conflict of interest policy.
I think we're done with the actuary. Thank you, guys.
Thank you.
Good.
Appreciate it.
Huh? Great. I like beer. Can't say that. I like beer.
Yeah.
Trouble.
Thank you, Mr. Chairman. Trustees, you have the conflict of interest policy before you. There are only some very minor changes proposed in here. Recognizing that we have more than one plan sponsor. It's the only substantive, it's not even a substantive change, it's a language change contained herein, and then updating the executive director's title.
Okay.
This was due for review this quarter, so that's why it's before you.
Someone want to make a motion to approve the conflict of interest?
I move to approve
I'll
this.
second.
Okay, all those in favor?
Aye.
Any opposed? Okay. Great, then we're on to possible action regarding placement of agent disclosure policy.
Thank you, Mr. Chairman. Trustees, you have the placement agent disclosure policy before you. It's due for review this quarter. There are no recommended changes to the language in the policy.
I move we adopt the updated policy.
I'll second.
All those in favor?
Aye.
Okay, and that puts us over at regarding the administrative report.
Thank you, Mr. Chairman. Trustees, you have the administrative report before you. I did want to highlight the proposed board meeting calendar that's included with the administrative report. This will come back before you in December for formal approval. We do have several months where we're suggesting alternate dates besides the third Wednesday, specifically being November and December. The third Wednesday in May, which is typically moved, actually falls the week after the SACRS conference, so there's no need to move it there. And the date didn't get highlighted on this draft, but the proposed meeting in March would be March 20th. So just have that before you. All of you should have received an email from FGA about the governance evaluation, asking you to complete that by the end of November. Being the first, if you didn't see the email, check your spam or junk folder. It may have gotten sent there. If you're having an issue and can't find it still, let me know and I can resend you. The opportunity to be first is long since passed. So I will recognize Trustee Shoemaker was the first one to complete the survey. So.
Because he sits in front of a computer all day, right?
Yeah, I did, I'm a break.
Yeah.
Also, I hope all of you brought your checks.
No, of course not.
Got my checkbook.
So,
Our
the
insurance.
fiduciary insurance is
$9.
due.
Oh,
Need your check for $9 made out to MSARA for the waiver of recourse. So, if you didn't bring it today, like I did,
oh,
please bring it next month. Or you can bring it into Judy at your leisure.
Some of us know how to follow order.
I have a check, it's just blank.
And as directed by the board, I have provided clarification to MSERA staff on how we're going to handle emergency declarations. That memo has been sent, so.
Yeah, saw that.
If you are traveling to Sackers, please chat with Judy or I after the board meeting. There's one little thing we need to make you aware of. Judy, remind me if there's something else I'm missing here that I was supposed to talk about.
No, that was the most important.
Okay. That concludes my report, Mr.
Okay, do
Chairman.
we have any board members? items?
I just had a question on the report, the investment consultant RFP.
Mhm.
When are we learning who the presenters are, who the finalists are?
We will have the finalists here in December to present, and we are still working through the list to determine who the finalists will be. Some of the work has been done. The field has been narrowed some, but not necessarily all the way. So we're still working our way through it. We will be bringing the I was not planning on sending any communication out to the board in advance. But if that's the will of the board to learn far in advance of who the finalists will be, we can do that.
Now, Callan, I mean, since they've been our investment advisor they would be in that group more than likely, right?
Yes.
Okay.
Yes. Yes. Staff is not going to make the decision that we will be changing, so.
That's what yeah.
That would be a
That was the only
decision
thing
for-
I would be concerned about if all of a sudden it came back and they weren't they didn't make the cut, that would be, yeah, perfect, thank you. Good answer.
My only request is going to be, I didn't know, I haven't been present for one of these before, if there's a lot of material to go through, if there's any way to get it earlier than, the Friday before, I would definitely appreciate that.
So the proposers have submitted a response to a lengthy RFP, and it is not my intent to put the full RFP before the board. That's just way too much material. But we will be giving the finalists direction to prepare a presentation deck, and that will be part of the board materials, and you will have that in front of you. But I'm not expecting that to be any longer than at most 40 or 50 pages from an individual presenter, and that's way too long at that point. So our strategy with the search has been to make sure that we're bringing the board candidates that are highly qualified and best fit the needs of the board and staff. And then it really, once they're at the finalist stage, I think it's going to come down to who the board is most comfortable with. And that's going to be the consultants that are here on a regular basis, so.
Thank you. Do we have any other board member items? Okay, with that, we're going to adjourn at 11 o'clock.
You can give them the challenge of doing a one-sheeter. See if you can do that.
That'd be great.
Put it in the bathroom. That was pretty good, we had a lot to cover today.